я соскучился по конференции, я традиционно ее открываю, и у нас было 2 года это мы не делали. Да? 3 года не делали, да. И хорошее начало и в совершенно новом месте, Вильно. Я вас приветствую. Нас, наверное, так мало на открытии никогда еще не было. Но я надеюсь, что люди подойдут. А в следующем году, я думаю, что это будет более полный зал и больше народу придет к нам на эту конференцию, потому что я надеюсь, что мы с ЕГУ продолжим свое сотрудничество, будем формировать факультет, и, безусловно, это даст большую коммуникацию с нашей целевой аудиторией. Да, я Павел Данейко, и я административный директор BEROC. Вот академический директор будет закрывать, а я традиционно открываю. И мое выступление на русском языке – это единственное выступление на русском языке, которое будет здесь. И я бы хотел передать слово Сергею Игнатову, ректору ЕГУ, поскольку конференция наша совместная, то поэтому он и запустит ее.
Thank you. Спасибо. How to start in English or in Russian? Maybe I'll start in English and after that some jokes in Russian. I'll continue. Okay, dear distinguished guests, dear colleagues and partners, it is a great pleasure for me to greet all of you here at the 10th International Conference in Economics and Finance as rector of the partnering institution European Humanities University. Today, Belarusian youth has no access to economic and business education of good quality, which is demanded not only in Belarus and the region, but also in the rest of Europe. There are no good conditions inside the country to rise up a new generation of economic and business leaders. Belarusian private business sector inside the country, which was the engine of the movement of democratic transition since 2020, is vanishing not only because of migration and the impact of sanctions, but because of the lack of human capital as well. For relocated business, the lack of professionals is argued to be the most severe obstacle to their development. Relocated Belarusian business is a good environment for bringing up new business leaders. Moreover, it is important to support the relocated Belarusian private sector with the necessary skills. Such leaders will show Belarusian people an alternative that can lead to a better life. They can professionally promote the values of democracy and the sustainable market economy for the Belarusian people and push the process of changes in the country. In current conditions, the most effective way to save and promote the development of Belarusian human capital and thus contributing to democratic transition is to prove high-quality economic and business education for Belarusian students and Belarusians outside the country. Therefore, we share this idea of uniting our resources and offering an ideology-free education for the next generation. And because I represent European Humanities University, where I have been serving as a rector, when was that? Starting from 2018. I'll give you some important information about this university because we have plans to continue together in the future in the field of economics and finance with BEROC. European Humanities Universities, as you may have heard, was established in 1992 after the collapse of the communism, and maybe this is the last year of the Soviet Union. And this university is European Humanities and University because it's focused on European intellectual tradition. This is the most important. It was most important not only for Belarusian people, but for all the region, Eastern Europe. I'm Bulgarian, and in my country, in the same time, a year earlier, was established similar university focused on humanities, social sciences, and arts. Why? because this was the end of Homo Sovieticus. There was a need to remind the people of Eastern Europe and former Soviet Union that they are first Europeans, but not Homo Sovieticus, or Homo, in my case, socialist or communist country was this, how to say in English, I don't know. And that is why several universities were established in Europe. The most famous now is Central European University in Bulgaria, New Bulgarian University, who became the leader not only of private sector, but is competing with the most important state oldest university in the country, American University in our country, and European Humanities in Minsk. And what happened, you know, in 2004, university was shut down brutally by Lukashenko himself. And he was very proud of this because this brainwashing institution was closed because we don't need Western professors to walk on the streets of Minsk, for example, in that time. And with the help of European Union and United States, this university moves to Vilnius. And now the university is financed, of course, by Lithuanian government. European Union is the main donor, Sweden, and we have, of course, donors all Nordic countries. We have private donors as well. And this is a private institution, but public, non-for-profit. This university has a very interesting structure. There is a General Assembly of part owners. They make decisions about the future of the university. Governing board, which this is not an institution to make decisions, but more consultancy. That problems are discussed. This has been discussed there and sent to GAPU, for example, or to the management of the university. And there is a rector with the management body of the university. We have now three departments: humanities and arts, social department, and starting from this year, EPAM IT school. This is a branch of our university. They're independent in some cases of our university because they're supported by a PAM system, not by the donors. This is very important to know. And of course, now we are in this, we are on our way, and I think that this is the track way of the development of our university to start common projects with BEROC. What is the most important thing is that this university, European Humanities University, is Belarusian, but in the same time Lithuanian university. Because this university has accreditation here in Lithuania, according to Lithuanian and European requirements. All these requirements are coming from this central body, NKOA. This is the enemy of all universities in Europe. This is an accreditation agency which shares all requirements, and it's not possible to escape from this. When we speaking that this is Lithuanian university according to the legislative system, this is European university. Our diplomas are European. And we are facing now new accreditation, this 2023. There will be accreditation, there will be evaluation of the research, and starting from October, there will be changes in the financial management of the university. Now we have this core finance from our donors, but starting from October, the new system is going to be introduced, voucher-based, scholarship-based system. And of course, this is very challenging because now our students pay tuition 2,500. This is the average cost, but the cost of education is about 5,000, between 4 and 6, depends on the programs. It means that every single student, even if he or she pays, receive 50% support from the donors. And what else? What else? The university was very small when I came. We had less 600 students. Now we have 1,200. And the most important thing is that our university is very dynamic and active in increasing research activities, educational activities. For example, 2017, every single department has had about 10 publications per year. Can you imagine? This is nothing. Now every single department has the information is from yesterday, 255,6. This is not in comparison to big Lithuanian or European universities, but starting from, in these 5 years, from 10 publications to 255,6, I think that this is a big success, and the trend is to increase the research activity, because I believe in the building of the body of university. I don't believe in donors' support. And the future, if this university wants great future, it means that in very close future, this university has to be dependent not on donor support, but we have to be dependent on ourselves, our activities in the field of research, education, new programs. Of course, third mission, university is very active in links and working with Belarusian civil society, and I'm very proud of this, because even for me this is a big experience, because I myself, I was rector in my country two terms at this new Bulgarian university. I'm one of the persons who established this university, invented it. After that, I was Minister of Education, Youth and Sciences. I had the chance to close all heritage from the communism in the country. But I'm Egyptologist in my as a profession. I'm professor in Egyptology. I run an expedition there in Egypt, and that is why the joke is that do you know what are the first money in the world history? The first money are not money, but this is a beer. Because 2,000 years before Neolithic period, in Göbekli Tepe, this is now in Turkey, they started to build a temple. And the problem was how to seduce these free people who are moving in this area. They were seduced by beer. And these people, they're first in world history who started to make beer but not bread. 2,000 years later, they started. The humankind had this experience to make bread, but the first seeds were for beer, not. And this beer was the first money. They paid to eat beer to all these free men hunters who was around to build this temple. And because this conference is focused on economics and finance, I decided to give you this information about the first money in world history. Thank you. Pavel, I'm ready.
Thank you for the introductions, and we are now going on with the main economic part of our presentations, and we start with Yuri Tserlukevich from Arizona State University. Yuri is also a member of our academic board at BEROC, so thank you, Yuri, for coming. And Let's wait for technical details to be figured out.
Here you go. That's fine. Good morning. I'll start in English as well. I have advantages opposed to some younger colleagues here. I've been with BEROC long enough to start with the first conference that I remember, and I hope this is not the last one, obviously. Let me say briefly about BEROC. There is no, especially for those who don't know, we don't have any alternative to another center of international research and local education and local policy. So my hope with organizations that it continues for many years, simply because we don't have anybody else to take the place of BEROC. So anyway, let me start with my most recent work. This is I work in finance and theoretical finance mostly. The new project on related to corporate hedging and derivatives. So I'll try to adopt the slides to make it easy, even if you do not know much about the topic. Anyway, so first of all, what is hedging, also known as risk management? That is the financial way of reducing risk. This is usually using some kind of derivative such as swaps or options to ensure that the company does not go into state of distress and does not default. Given how I explain it, given how I give the notion of hedging and derivatives, it's easy to understand that it's most valuable when company is close to financial distress. So if the company is very risky, the company is already compromised, this is when it needs the most the portfolio of the derivatives to make sure that no further risks can jeopardize its value. Given this concept, many of the previous papers argued that because of the management risk, personal risk aversion, or because of possibility of distress, risk management is the most valuable for distressed companies. However, empirically, we see that companies that are close to default, companies that are distressed, they're actually the least likely to use derivatives and use hedging. So why is that? A possible explanation came up based on the either constraint, that's Rampini-Vestavasan literature. That literature argues that because of collateral constraints, the firm has to choose either to invest or to do risk management. Therefore, risk management is insufficient because the company already has no money for investment. The simple explanation sometimes is that the company is close to distress. They are too distracted to think about the risk management because they have other problems. Anyway, so what is this paper about? We look deeper into how the hedging is done. It's done not how we usually imagine. You cannot go to the market. You cannot buy those options on the market. Usually you have to sign a contract, and the way those contracts are signed is governed by specific contract, which is the same for all over-the-counter, that's like person-to-person, entity-to-entity transactions in the United States. It's so-called master agreements, that they're all the same for all transactions, and those master agreements dictate that if there is some event of default, which I'll explain in a second, there is an option for the counterparty to terminate the whole portfolio. We argue two things in this paper. First of all, this option to terminate derivatives if the company is in distress explains low level of corporate hedging contrary to theoretical literature. And second, we investigate the value of this option and the exercise strategy for this option, so that for the methodological purposes we understand what's going on. Okay, so that's pretty much overview. And I'll try to explain as much as possible. I'm skipping all literature and going straight to contracts. So what are we talking about? So it started in the United States about 30 years ago, and now it's pretty much all over the world. There is a organization called ISDA. So for example, you go to United Kingdom, you have to sign an ISDA contract, or for example, there is ISDA here in Germany and Lithuania. That's an organization that governs common contract for the derivative transaction between the counterparty, think of some large bank like Deutsche Bank, and the company, think of some like oil company. So the oil company contracts with Deutsche Bank, they sign this contract, which is the same for everyone, it's 10 pages approximately. So in this contract, somewhere in the end of this contract, there is part that says when this contract can be terminated, and it's contingent on the so-called event of default. What is event of default? The contract gives 8 standard events of default and gives addendum with additional events of default. It's basically any kind of default. So the company did not pay, the company did not make a payment on current transactions. It can be triggered if there is a large credit downgrade. It's also triggered if there is a merger without full assumptions of all liabilities. It could be if they don't file documents and a couple other things. So basically, when something is wrong with agreement, then it automatically triggers event of default and the whole portfolio can be terminated. Okay, so it's important that upon triggering the event of default, there is an option but not the obligation to terminate the whole contract. So we investigate when this option is terminated and when it's not. And there is some kind of grace period. So immediately the company does not need to see that all of its agreement is gone. There is some time for the counterparty to think whether they will terminate or not. Okay, so here's now closer to examples. Here are the examples that we see in annual statements. So by the way, from the finance perspective, so maybe as most of you economics people, so let's say you need to know something what's going on in the company. The advantage of finance, you can go to if it's a public company, you go to the website for Security Exchange Commission, you download the annual statement of this company, and although it's a very large document, you can read through the statement, figure out what was the derivative portfolio, why they don't have derivative portfolio, what financial troubles they experience. So you can pretty much know everything. So they say directly, here's a company, Aurora Oil Company, that hedged with BNP Paribas Bank. They say on 2008, in the middle of the crisis, we received a notice for early termination from BNP Paribas with respect to our natural gas and interest rate swap derivatives. So what it means in simple language is that the bank sends a notice to the Aurora oil company saying that because you did not make one of the timely payment, all of your portfolio is immediately terminated. So similar examples for other companies, except maybe for we found some examples in annual statements of other companies that are not related to defaults at all. So here's one example when companies were hedged with Morgan Stanley, and they, for whatever reason, in 2020, they were not able to make disclosure about their current financial position immediately. And as they don't timely file the 10K, which is annual statement, or they don't make some disclosures that are required by the agreement, it triggers the event of default and all portfolio is terminated. Okay, so I hope I gave you some idea. So now let me go through literally 5 quick pages of the model to give you an idea of what we're trying to capture, and then I'll explain to you empirical work. Okay, so we built simple binomial model, so it's not a continuous time, it's not a derivative value, not a kind of option value model as you might usually expect here, because we simply wanted to capture for now the intuition of option exercise. So without going into mathematics, here's what the model does. We have a company that initially is healthy. The company signs the agreement for hedging, so it signs, for example, with a counterparty with BNP Paribas. It has a hedging contract in place, and 2 situations are possible. The company either remains, so think about some kind of binomial trace, like good situation, bad situation. In a good situation, the company remains healthy and nothing interesting happens. So there is very high probability. Think about 90%. With some small probability, say 10%, the company experiences distress and goes into a state of default. For example, it fails to deliver some payment, or it experiences a credit downgrade, or it violates one of its covenants. So the model basically starts in this bad state of the world. We assume the company triggers this bad event, and we start from there. Conditional on this bad event, we assume a single number v, which is value of its derivative portfolio, to the counterparty. To make concrete example, there is say bank that signs the derivative, say Wells Fargo. That's the value of these derivatives to Wells Fargo, and minus v is a negative value of the derivatives to the firm itself. Now, so anyway, what do we have? We have a company that can get into event of default with some probability, and now it experiences distress, and there is some derivative portfolio that we need to describe further. Now, some of you are familiar with contracting literature. So you know, in contracting literature, let's think about Tirol's textbook, for example, if you're familiar with it. Without any further what we call frictions, there is nothing really. So contract is fair, it's signed, at the end contract is resolved, nobody is worse off, nobody is better off, there is nothing interesting. So to make sure that there is something interesting, we introduce frictions. Here's my frictions. First of all of these frictions are taken directly from the annual statement. We just put in the mathematics what companies say in the statement about the derivative portfolio. First of all, there is a value to the counterparty of continuing doing business with the firm. So basically, in plain words, the bank wants to continue business with the corporation that's hedged. They don't want to cut the contract because they know it would be hard to establish new contract. So we put a value theta on continuing contract. Second, we recognize that after the contract is in place, and there is an event of default, so the company is already in this bad state, they're already not doing too well. There are two possibilities. The company can either be liquidated if the things become even worse, or the company can recover. So we must recognize that this probability of recovery also depends on having derivative. If derivatives are in place, it's easier for company to recover. We also must describe realistically what happens if the company does go into full default and liquidated. And there, from how this companies describe the process, the bank, the counterparty, has two incentives. If they have to pay to terminate the contract, then they would probably delay liquidation because, like the case of Lehman Brothers has shown, the resolution of the process takes a long time, and if you must provide the payment with a termination notice, then it's much better not to terminate at all. The second, on the other side, if the counterparty, think about the large bank, is expected to receive payment with a termination notice, then they have high incentives to do this sooner, because if the corporation goes into default, then it's much harder to recover money from defaulted companies than to recover money from the companies that's still alive. So we introduce this as cost alpha and cost gamma that are proportional on the value of the derivative. Okay, so in the interest of time, let me just show you very brief mechanics of the model. So again, simplistically, you have a firm that's healthy and signs some derivatives. Could be nothing, the firm could continue as a healthy firm, or it could go to event of default. So this is already low state. From low state, you can go to even lower state, which is liquidation, or you can recover. The probability of recovery depends whether this P depends on whether company has derivatives. And if it does recover, nothing interesting happens except that there is a value of continuing and having those derivatives in the future. If it doesn't recover, then there are some costs on positive or negative portfolio. So we take it basically into, let me skip to this formula. We'll take it to mathematical expressions, and we get to the formula. In the interest of time, I'll only focus on the exercise formula that shows that exercise of the option, we're talking about the option to terminate all derivative portfolio, depends on the value of continuing business. So the larger the value of continuing business with the firm, the less likely the portfolio is to be terminated. It depends on the deadweight cost of bankruptcy. So intuitively, the more costly is a bankruptcy, the less likely the bank is to leave money with a company when company is about to go into full default. And the value of renegotiation. So intuitively, if the counterparty must provide the payment with terminated derivatives, it actually wants to drag the feet and don't provide this payment, because it's very likely, like in Lehman Brothers, which defaulted in 2008, but until now the payments are not fully made. So it's beneficial not to make this payment immediately. Okay, so that's about the model, and I will not go into any extensions or anything. Now let me use maybe my remaining couple minutes to talk about empirical results. So like I mentioned, I usually work with modeling. So this particular project was interesting to me for a couple of reasons, because we had to assemble very large amount of data. So instead of kind of going through the details of tables, which I can do, let me just explain to you interesting data that we use in this project. So we needed 3 types of data to describe the process of derivatives in the company. First of all, most importantly, we had to know the details of the derivative portfolio for each company. Where do we get it? You only can get it from the annual statements, so you need to read basically manually through this annual statement, figuring out how much this companies hedge. Second, you want to know when these portfolios were terminated. So for this, you need to, again, go to annual statements and find those places to see where the portfolio was terminated. Finally, since the termination of all derivative is contingent on the events of default, we have to find those events of defaults. So let me start with this. So events of default we find through several standard databases, and my colleagues that provided the full set of 3,000 derivatives for United States corporations that filed for either Chapter 7, Chapter 11, or experienced any kind of default in distress. For the amount of hedging, so for the hedging, we did 2 things. First of all, we assembled a very detailed sample of the derivative transactions for companies that are in oil and gas production, in coal, in airlines, and steel producers. So there are 2 advantages here. First of all, for those companies, you know what they hedging and how much they hedging if you look in the statements. It's not possible for any other industries. Second, we can spend a lot of time kind of, because it's a small sample, it's only about 2,000 firms total, we're able to read it in detail, so we're able to identify everything. We don't need to rely on mechanical ways of collecting this information. But because you also want to kind of to establish this for the whole universe of firm, we also run it for all public firms, the same search. How do we do this? I use textual search. So I have a new program that basically downloads all annual statements for all companies for all years and just mechanically searches through the statements. To identify whether companies hedge or not, we collect the number of the words related to hedging, such as hedge, risk management, forwards, forward contract, futures, and swaps. And the more times the firm mentions it, the more likely that it has hedging portfolios, and we divide it, normalize it by the number of words. We also look for the termination of derivatives. So for this, we have a 3-step process that identifies the paragraphs where they're likely to talk about the derivative being terminated. We identify those paragraphs, we save them in the files, and we read manually, and eventually we confirm that the portfolio was terminated. So very briefly about the results. Now I want to point to just a couple numbers. For the small sample of commodities, we see that many of the, out of about 4,000 year firm observations, we observe 140 that had distressed firms, and about 95 that result in derivative termination. So if I put it briefly on a graph, calling 0 the event of default. So think about this firm either defaulting or experiencing credit downgrade or triggering the covenant violation. You see the derivative portfolio that we estimate to be 40% on average goes to pretty much 0 during this year, and that recovers in the long term. Usually this is explained by firm not being able to hedge or not willing to hedge during this transaction. Our point is much simpler, that the portfolio is mechanically terminated because of the agreement, because of the contract infraction. So we separate these firms into the firms that are going through expensive bankruptcy or going through cheap, so kind of prepackaged bankruptcy. And we see that for cheap bankruptcy, there is no effect on hedging. which is consistent with the model prediction that for cheap bankruptcy, the portfolio can be terminated at no cost. And for other forms, you can see there is a significant effect. So let me see. Here we go. So another graph that I want to show you, because we can look in annual statements and we know that portfolios were terminated, we can separate our sample into the subsample of the firm when we know there are terminations, and we confirm that hedge ratios are much lower for those firms, and the firms that did not say that they terminated the derivatives, but they could, and for those, we can see the red line, we can see that there is no change. So we run a number of these tests, basically confirming that terminations have significant effect. Let me show this last result and probably end here. So we run also a number of placebo tests to show that the contractual terminations are responsible for low hedge ratios. We look, for example, in coal industry. So here's what's going on in coal industry, again, because you probably wouldn't know about derivatives. In the coal industry, what they do is they use several inputs and they produce coal. So it turns out that they don't hedge the coal production. The production of coal, so they produce, say, 100 million tons of coal. It goes through the so-called supply agreements. So the coal producing company already has a predetermined price, say like $1,000 per ton, at which they produce the coal and sell it to consumers. What they hedge is a fuel derivatives. So because they use a lot of diesel fuel to produce the coal, that's a derivative that they use. So we take a coal industry as a placebo and we separate the hedge ratios for diesel derivatives, which is subject to credit terminations, and coal supply agreements, which is also hedging, but it's not subject to any agreements about cancellation. It's not subject to terminations. And of course, we see that for the diesel derivatives that can be subject to termination, during the distress, the hedge ratios significantly fall. And for the coal supply agreement, which is also hedging but does not use derivatives and not subject to termination, there is no effect at all. So by this, we confirm that there is a simple mechanism behind changing derivatives values. Okay, so I don't want to keep you over time, and I'm skipping the rest of it. What do we find? So we this is one of the projects that we've done in the hedging and the derivatives on the corporate level. The literature before us argued that companies that are distressed, corporations, do not hedge because usually they are constrained about the hedging. For example, they don't have enough collateral to hedge if they are already distressed. We show in this paper that the reason may be much simpler than was thought before. Because all derivatives in the companies that were used in previous studies use one type of agreement, ISDC master contract, the derivatives are simply automatically cancelled when the companies are distressed. And because they're automatically cancelled, we see empirically that those companies do not hedge sufficiently if they're distressed. So we provide much simpler explanations for what had complex explanation before. We also explore when this option to terminate derivative is exercised and the ex-ante value of this option. Okay, so thank you for your attention and good luck with the rest.
We still have some time for questions, actually,
yeah,
plenty
sure.
of time. So any questions are welcome. And we have to use the microphone so that people in Zoom and YouTube hear us.
Probably. Left hand.
Okay, so thank you. And correct me if I understood it wrong. So this hedge is actually not a real hedge because these hedgers cancel it once something starts to go wrong. And like the only reason why they won't cancel basically this insurance is because of friction of this reestablishing this contract. And then why won't? Well, I don't understand, of course, this world. Why won't somebody invent real insurance?
So I see. So Lev's question is basically can be translated like this: if these derivative contracts that are meant to preserve to keep the firm from going to default, are cancelled in
Insure,
default,
yeah.
what kind of insurance they provide? So the answer is as follows. So derivative contracts, at least corporate derivative contracts, are settled every couple of months. So they work as intended as a firm kind of doing worse and worse. For example, it's exposed to falling oil prices and the company produces oil. It's an oil pumping company. Then as the situation becomes worse and worse, they keep receiving payment from the derivative counterparty. So they help in this situation. What I'm describing is when the situation cannot be helped. So they received payment from the bank, they received payment from the bank, they received payment from the bank, but they still violated one of the covenants in the end. Then all the portfolio is terminated at this point. So what we're arguing is if the situation became very bad, the company actually defaulted on one of its obligations, it had all of the portfolio terminated, and then it cannot, at this point, it cannot survive, or it's harder to survive further, because in this critical point when it really needs portfolio derivative, it doesn't have it. But it doesn't mean that the portfolio is meaningless, because there were several years probably when it received payment before the termination.
Okay, and then another question. So in your model, it's basically everything is exogenous. People are not making decisions, and company is not making a decision. But what if you would acknowledge incentives of firms? So if this would be not just like random shock, but strategic behavior of firms with respect to like doing all these obligations and not, how it should change this picture?
Yeah, so that's absolutely correct. So the company is passive here. So they're basically victim of the derivatives counterparty. Now, it could be easily extended in several ways. So first of all, the company has discretion to sign or not to sign derivative agreement. So you could consider those situations, whether they go into agreement or they don't go into agreement. Second, the company has decisions about whether to issue debt or not, which increases or decreases its risk. And other than that, the company basically has no... Oh, there is one more thing. The contracts are two-sided, the derivative contracts, which means that if anything goes wrong with the company, the bank has the right to terminate all transactions. But if anything goes wrong with the bank, the companies have a right also to terminate the portfolio. And that happens two times. With Enron company, there was a large oil derivatives company, and the second time with Lehman Brothers, for which I was supposed to work for Lehman Brothers, but I didn't go there, luckily. So Lehman Brothers defaulted with a 6,000 master agreements. So all of this master agreement counterparties, they had to decide whether they terminate the transactions with Lehman Brothers or not. In this case, that's not the company that went into default, that's a derivative provider that went into default. So they also have some role, which we don't model in this model.
Okay, thank you.
Thanks.
To follow up to some extent on Lev's question, let's give it a name. It's called risk shifting. So my basic question is, why do you find puzzling the fact that distressed companies don't hedge? They're limited liability companies. You're only looking at publicly traded ones. They don't have incentive to fully hedge. They have incentive to risk shift and become riskier. And secondly, unrelated second question is, why not look directly at cancellation since you have it in the data? So you're showing that the overall hedging drops in the period of default, but that could be due almost entirely to risk shifting. Why not plot how much of that is due to actual passive cancellations of the existing contracts? Mm-hmm. Thanks.
Yeah. So question. So let me briefly explain what. It's a good question. Let me briefly explain what risk shifting means on the corporate side. It's when companies have liabilities. For example, they have debt with a senior lender. They might have incentive not to survive, but they actually have incentive to increase their risk, because if they default, they're not liable for payments, and if they survive, they get their money back. Now, so there is, well, first of all, conceptually, there is a big question whether the risk shifting exists for distressed companies, because like managers, they obviously want to stay in power as the companies want to survive. So there is an empirical question whether risk shifting takes place for distressed companies or not. So the conclusion on the empirical side is basically risk shifting may appear in some cases, but in many cases it does not appear empirically. Now, there is other thing. The hedging is controlled partially by the lenders. So the senior lenders in the credit agreements, they have very large part that says how you can use derivatives and how you should use derivatives or not. So basically the bank tightly controls the risk management for the company, and in fact they say what happens if your derivative is terminated. They say try to reinstate it as soon as possible. So in fact the bank, who would be the victim of the risk shifting, has a control over how those derivatives are placed between the company and the counterparty. So basically, the easiest way I can explain to you is there are three parties in these transactions. Usually there is a company that wants insurance, there is a bank, there is one bank that provides insurance, like you think of Wells Fargo, and there is a lender who would be affected if the company does not have insurance.
Oh, I already have the microphone. Exactly, for the risk shifting. I'm just thinking why the companies would be interested to hedge, and why is it really under hedging problematic? Because from the point of view of investors, you have the company, a risk-return trade-off. So if you want to invest in a risky company, you do that. If you want to manage the risk, you buy CDS insurance or anything else of clients themselves. So companies shouldn't be really caring much about this. Right.
So yeah, several questions, all good questions. So CDS, like it's a popular, CDS is a credit default swaps that's supposed to provide you with a perfect insurance against your own default. So supposedly the company can buy insurance on its own default and always get rid of, but this only works in model. In reality, they're too expensive to buy. So nobody in practice does it. So now about risk shifting. So again, risk shifting, even theoretically, it works well if you have like, imagine binomial setup when you take a very large risk and the gambles pays off, you are paid, and gambles fails and you are deep under, right? And then the lenders have to pick up the rest. But here the reality is that you have a continuous hedging agreement, so you have a lot of payments in between. Then you get to the point when you have no money, basically, you already defaulted on some of the obligations. And at this point, you can risk shift, but basically all you win is you out of business or you in business with a little bit of money, but there is not much of put option. You're not going to win much even if you decide to risk shift. So my assumption and my understanding from annual agreement is that managers want to keep the companies afloat at this point because they keep employees in place, they keep their salaries, but there is not much benefit at this point of changing risk. Thank you for your questions. I want to make sure that others have time.
Okay, and no more questions, I guess, because we still have some time. Okay, thanks. Thank you, Yuri. And the next one is Dmitri Boreiko from Free University of Bozen-Bolzano. Well, Dmitri is also an old friend of ours. I was trying now to actually find the year when you started cooperating with BEROC. I couldn't do it, but I guess it was many years
12,
ago.
yeah.
Welcome, and the floor is yours.
Thank you. Yeah, it was a big pleasure for me to get in touch with you and reactivate my cooperation with BEROC. So I'll be presenting today my recent research with two financial law scholars. It's on SPACs, because SPACs, since the beginning of my career, I was dealing with the securities issues. So initial public offerings, seasonal equity offerings, then I moved to crowdfunding. Then I started, I researched a lot initial coins offerings, so crypto tokens, which are issued by companies to get financing. And SPACs actually is additional new interesting phenomenon, which was in a very big, was very popular in 2010, 2011, and now with all the markets going down, it's actually following suit, and so it's almost dead, but it's not yet. And therefore, I mean, why not researching it, right? So we have the full cycle already. And I try to, since it's the first time I'm presenting this research, I try to make it a bit less academic and more entertaining. So I will be talking more about what are SPACs, how they function, and what is the rationale behind them, why companies would prefer to do these strange transactions instead of issuing shares, using the initial public offerings instruments, well-established process of getting financing and becoming public and famous and so on. And therefore, the brief outline is that mostly I will talk about SPACs, about US evidence, because there is no much evidence outside of the US. We do contribute a bit here with Italian data, because this is surprisingly one of the most active markets in Europe and the world after US and UK for SPACs. And that's the picture about SPACs activities and IPOs activities. I'll be later talking what is SPAC. So, but first, just see that we're comparing IPOs here with the SPAC activity, and this line shows you that SPACs are peaking in 2021, then going down to Q2. Well, if you continue, it will be somewhere here, and the IPOs as well in blue. So SPACs at some point of time were much more interesting and popular than IPOs, right? But then you see this wave which is going up with the quantitative freezing, lots of money. Many people try to use the conditions in the markets, get public, get money before investors start to realize that something is going wrong. If you compare, well, the Bitcoin price here, I like to put crypto everywhere where I can, even though there is no much correlation. But you see the same wave here, right? So all the asset prices were following this kind of pattern when we have this peak in 2001, and then the winter time for crypto, winter time for stock markets, and so on. So peak going down, what happened? Why SPACs were so popular? You have lots of industry research, and very surprisingly, not very much from the academia, where they talk about SPACs, that SPACs frenzy, SPACs are great, and it's the best way for companies to get public, and it's so nice, everybody wants to go through SPAC. There was this very famous SPAC of Bill Ackman, who actually collected $4 billion to find a unicorn and to bring it to make it public instead of going through a costly IPO. He failed actually, so he gave money back to investors. This is a very interesting thing in SPAC, that if you are not successful, you just give the same amount of money back to investors, so they're quite safe and protected from the downside. And you have lots of successful SPACs when the private company, all of a sudden become public without going through this underwriting agreements about roadshows and publicity, spending money. But you have lots of failures. If you look at the performance of the companies which became public through SPACs, and this is a long-run performance across various industry, you do see a lot of negative numbers. They are not in red, but this is all minuses. So the performance from 2009 up to the third quarter of 2021, if you look on the average, is horrible. I mean, the companies actually lose money. We know that IPOs, 2 years after they go in public, they as well underperform. However, the underperformance is 10%. Here you see this horrible statistics which shows that the companies which became public actually were losing money on a large scale. And the idea is that why investors would be interested actually to buy shares of such companies if you see consistent underperformance, which is, well, of course, it's on average. So sometimes you have good companies, somehow you have bad companies, but average tells you that it's really minus. Well, let me start before going to SPACs, just briefly outline why the companies go public, why they want to issue shares to the general market and trade, become transparent, having to publish lots of financial information, disclose information to the competitors. Well, the conventional finance theory tells that the company goes public because they get the access to the capital, they get the liquidity, they can grow easily through acquisitions or partnerships, because if your shares are traded, you can buy now companies with shares. Before you have to pay cash, now you just give shares instead, which is for you as a company really sometimes is much more beneficial. And so this is additional advantage. Plus, when the shares are traded, the remuneration of the talented managers is much easier, because you just give them stock options, you align interest with shareholders, because managers would like to make the company grow, the share price grow, because then they exercise the executive options and get lots of money. So, and more transparency and less asymmetric information, of course, because investors might be worried about companies which they don't really know what's going on inside, right? And with public companies, it's a public status. You have to publish lots of information, be transparent, and therefore investors might be trusting more the company and be more interested to include the shares of the company into their portfolios. How the companies go public? Well, initial public offerings, when you have the investment bank as the underwriter who does everything for you. You just come as a company to them, you pay them quite a substantial amount of money, but they deal with everything. The early evidence, there was a famous article by Chen, which was called exactly, so you don't even have to read the article because it was called 7% solution. So you immediately know how much the companies pay to underwriters on average to get the shares published. We did the similar statistics for Italy. And in US recently it's 4 or 5%. So if you want to go public, 5% of the money which you will be probably want to raise, you will have to pay to the underwriters for their services. And that's why it's expensive. And many companies were experimenting and where the regulation was permitting, trying to get public via different methods. Some of them is the restricted markets, which is in Europe, in UK was quite popular because these are the smaller market for smaller companies with less stringent listing requirements, prospectus, no prospectus obligation, or restricting the investors which might buy the shares. For example, only qualified investors can buy it, or high net worth individuals. Sometimes there was quite not popular but frequent something which was called reverse merger. It's when a private company which wanted to go public, instead of going through the IPO process, what they were doing, they were simply looking for a public company, traded, small one, in distress maybe, then buying it, merging, getting, of course, the public status because they acquire this company, and changing name into their name. So that's why it's a reverse merger, because you acquire a smaller public company and you become a public company. Sometimes as alternatives, there was in US this shelf registration, when you prepare all the documents for listing, but you are not listing your stock, you just keep it on the shelf. And then if you decide to do it, everything is almost ready, so you save a lot of time on that. Special Purpose Acquisition Company, SPAC, is another alternative, of which I will be talking a bit later in the next slides. Just to mention that non-conventional alternatives, of course, finance is a very dynamic science, and they just try to use any loophole in the regulation. So equity crowdfunding is when you issue the shares of your companies to the crowd, basically through online platform, and they receive the shares of the companies. They cannot trade it, so it's 5 years freezing period. So it's not very popular at the moment because, it's risky investment and you don't get liquidity. You cannot sell it, so you have to stay with the company. But it exists at some point of time. It existed before and still now, but it's not really popular. Initial coins offering is another topic which I was researching quite a lot. When the companies, instead of issuing shares, issue tokens. So they get money. They bear no responsibility to tokens holders because there was no regulation about that, and many scholars couldn't even agree. What are tokens actually? Is it a security? Is it some sort of a scam or something like? It's nothing. So plus it's crypto, so it's a sequence of numbers. Nobody understood that thing. But companies, many companies, even non-blockchain based, managed before the regulation was not enacted or ICOs were not prohibited, raise some money. So they didn't have to do IPOs, they received the money they needed. But SPACs, special purpose acquisition companies. Well, SPAC actually is a device where some sponsors, experienced investors in the industry, practitioners, would like to collect money. 200 million, usually $100 million, sometimes even more, So they create the blank check company. This is a pure shell company. There is no activity, nothing. In the registrar, it's written that this is a financial company where they collect money from investors. Investors receive shares of these SPACs. Once you collect this money, why investors would do it? Because there is a promise that we use this money, within 2 years we will look for a private company which wants to get public, we will help it to get public, we acquire it or merge with it, and then you have all of a sudden shares are exchanged, you have the shares in the public company without IPO, and given that we sponsors, these guys, experienced guys are called, we have experience in that, we promise you a very good return on that. And as a result, investors give money to the company, receive the shares which are immediately traded, so there is liquidity. You can sell it if you want in the market after the first day of this SPAC IPO. SPAC managers put the money in the escrow account, so nothing happens with your money because this is the money for acquisition, for merger, and the investors can trade it. Plus, they receive not only the shares, they receive as well the warrants, which are the right to acquire the company at some additional shares for a specific price at a later stage. Interestingly, in US, you have to buy the price, for example, so warrant to acquire the share at $11 means that you have to pay this amount. In Italy, the warrants were given for free, and it means that if you have a warrant, you can get the share. So if the share price goes up to about 11, you can convert the warrant into the share at no extra cost. So it's additional thing for investors, right? They receive something which is potentially valuable. They don't have to pay for it. If the share price goes down, you just throw away the warrant. So it's a usual call option. Well, it's the Asian call option because you can exercise it at a specific each month given the average price of the share, but let's not go into these details. If the target is found within 24 months, it's a good thing. So SPAC is successful. If the target is not found, then SPAC is not successful. However, as investors, you don't care because you receive back your money plus interest because it's in the escrow account, some very tiny interest, but let's say you get your money back, right? So it looks to be like a free lunch. You receive the shares. If the target is found, you get the shares in the company. You can sell if the target is found again. You have to approve it as shareholder. You can sell the shares, get rid of your investment, and realize the return. And in US data, Rita, for example, showed that the average return is 9% annual. And it's almost risk-free, right? Because this is like a convertible bond. Because you have the bond, you receive a small interest, you get your money back if something wrong happens. If not, then you just convert your bond into the shares. Why? Because it's profitable for you. Shares value is much bigger than the value of the bond. As a result, you have a private company listed, funds collected, and investors happy, sponsors happy, everything is rosy, and that's why SPACs were existing, right? Looks very nice, like the collateralized debt obligations and subprime mortgages, so just beautiful. How SPACs happening? Well, before the listing, you have these guys, sponsors, which are very important. They try to convince investors, they try to persuade the market that they are able to find the targets, that they have experience. They list the SPAC. Sponsors usually contribute some money because you need to get it going. And as a result, they contribute, they have their skin in the game. They contribute initial resources, which are used to cover up legal expenses, startup expenses, and all these other things. SPAC is listed. Immediately, the investors can sell the shares. What is interesting, the SPAC offering is targeted to professional investors. So if you are a retail investor, and the whole purpose of our first paper was how the retail investors are protected in this setting, you cannot get it. But you can buy it in the market after the listing, right? So immediately the first day, usually, and in Italy, for example, the price is fixed at 10 euros for each share for every SPAC. In US, again, $10. So if you want, you can buy it at $10 and be the investor in SPAC the first day after the listing. If within 24 months the target is found, you can sell your share, you can keep it and receive the share in the target which you acquired, and then you are a usual shareholder because the company becomes public, completely like any other public company on the stock market. Why SPACs have become popular? The first and the probably most plausible argument is the speed. Because with IPOs, you have IPO waves which depend on the stock market and economy performance. IPO is quite a lengthy process, and many companies cancel the IPOs because they are late for the game. Because when by the time they want to get public, the stock market goes down. For example, now many IPOs are cancelled because stock market is down, and you cannot just get the money you want, right? Because nobody is ready to buy shares in the risky new companies. With SPAC, it's much faster. And the company which wants to get public, just find any suitable SPAC, agree on the price. The money is in the escrow account, so you receive pure cash. You just give some percentage of ownership to the SPAC shareholders, and all of a sudden you are public. So done. You receive the money, you become public. And that's more probably the biggest advantage of SPACs. Then again, you have sponsors. These experienced guys who lend the credibility, who lend the experience. So this is similar to venture capitalists who take the startup, train the young entrepreneurs, help them, and bring them to success and exit through IPO or strategic sale. Another thing about SPACs is that sponsors have to be sort of remunerated. With IPOs, usually they get the shares. With SPACs, they do get the shares, but these are special shares. So these are not traded and converted into ordinary shares only if the company is performing according to the milestones. For example, if the share price of the SPAC is above $11 on average for a month, then the sponsors can convert their special shares into ordinary shares, and then of course they can sell it. $12, $13, so there are milestones. In IPOs, this is not existent, and that's why it's quite good, because many people, then investors, believe that sponsors, if everything goes very well, then they will receive the shares. If not, they will not get nothing, no remuneration. So this is alignment of interest of the sponsors and usual investors who cannot, who are in SPAC actually quite passive. Then you have lowered threat of litigation. This is really a US issue, because when you do SPAC, this is like a merger, but with merger you are liable to the announcement of the potential cost cuttings and revenues. Here with SPAC you are not liable because you are protected. There is a safe harbor which says if you make an announcement of revenue and it's not actually realized, you are not responsible, because this, things happen. And more certainty about IPO proceeds, because you actually know how much cash the SPAC has and what it will give it to you for exchange of shares. With IPOs, depending on the conditions, depends on the book building procedure, then the price is not determined until the very last day. You have this range from 10 or to 20, and then it's decided according to what investors say, how much you were successful in finding the shares. So, seems to be SPACs are quite good. That's why probably many companies wanted to do them. Investors wanted to invest, sponsors wanted to promote, and companies wanted to be acquired. What we find in research about SPACs, well, it's only about US data, because the majority of them are from the US. And earlier studies have found that SPACs really destroy post-merger value, right? But based on this sample of earlier SPACs, which are not very many, then you have found that SPACs are very different. There is a very big cross-sectional variation. Some SPACs are quite successful and they bring you a lot of revenue. Some SPACs are really suck and they destroy value like hell. So it depends on you, if you're an investor, to be able to select a good SPAC and avoid the bad one. Coming in 2014 actually found that very counterfactual finding that actually if you have a big underwriter or sponsor, then you have worse performance, which was later turned objected and overrun by the future evidence, but I just wanted to include it for completeness. There are SPAC waves like IPO waves, so you've seen it on the picture at the start. And why SPACs exist? Because there is a demand. Some people want to invest in IPOs and get the share of the company. Of course, it's risky as well. If you invest in an IPO, you subscribe for a share, it started trading, there is no guarantee that it will actually go up and you will realize your return. Because normally with IPOs, there is something which is called underpricing. So money left on the table, where you have the company which deliberately underprice the share so that the investors immediately on the first day can sell it and realize, let's say, 15-20% return. And that is a very frequent, and we did, and many researchers actually studied this underpricing. Well, it's not really guaranteed because, for example, Facebook, who was listed 10 years ago, I think, they issued the share for $38. Right. So if you are investors, even private investors could participate and get the share for $38. The first day it lost, I think, 10%, and then in 3 weeks' time, the price went down to $21. Many investors wanted to sue underwriters because they thought it was actually a scam of some sort. Why they put the price tag so high, 38, when the market actually just decided that the price was 20. Later, the share went up to 100, 200, and nobody actually cared very much. With SPACs, it's a bit more risky because you may fail. You get your money back, right? But the SPACs might be successful and you realize high return. However, some researchers argue that it's smaller and riskier firms who wanted to get public with SPACs. And as a result, there was a demand from riskier firms who couldn't go to IPO, so they were getting through the back door, getting public with SPACs. Well, I managed to lose in editing one more slide because there was 2 recent papers, one by Klausner and another by Ritter, where they studied the phenomenon and they showed a very troubling results. If you are a SPAC investor and you don't redeem your shares, so you don't receive your money before the merger, what happens is the share value of $10, which you have, on average, transfers to $5 of cash, which is in the SPAC account. Why? Because of the conversion of special shares, because of the conversion of warrants, what you get is that you are losing money. You acquire something for $10. If you don't redeem and get out at $10, so you're not realizing nothing, you are acquiring a company, but effectively for $5. So half of your investment is already gone. If the company price is growing, merger is successful, good, then you actually compensate. But if not, why investors would do that? Ritter found that if you sell the share before merger, you realize on average 10% return. If you keep it with till the merger, so you are a long-term investor, you are losing something like 30%, 40%. And so this US evidence was quite troubling. They found as well that sponsors is not a very lucrative business. So there is no SPAC mafia, guys who actually put companies in, convert their shares into normal shares, sell it and get out. Well, that's not like that, they showed. And we were quite interested because we had the Italy data. And it's very different, this setting. So in 2012, there was regulation on SPACs in Italy, and they started to appear. By the moment, we still have quite a few, really, 30, but it's the 3rd largest market in the US. So for law and finance paper, the sample of 30 is quite okay. For pure finance paper, of course, you cannot prove much, but we tried to do something. And we looked at the retail investors. Are they protected or not? Because, the regulation has to deal with the equitable way all the investors are treated. And the retail investors are usually the small guys who go with the flow and they're taken advantage of by the big guys, the whales, the large investors, and so on. So we tried to look whether the retail investors participate in this market. And we looked at the institutional investors. Do they participate in the market? Couple of hypotheses we put forward. Then we studied that if there is a SPAC mafia in Italy, actually, and we looked at the long-run performance of SPACs and target companies after the merger. We also look at the cost structure. So whether it's really that the dilution is such huge that with a 10 euros share, the net cash value of the share is 5 euros by the time of the merger. We calculated long-term performance and try to see whether there is dilution and when it happens. When the companies are doing quite well, so the price of the share grows, or when it's not unrelated. So additional part of the research is on the contingent remuneration, which is called earn-outs in the US literature. So that's we are still trying to bring into shape to understand how it's going on. So what do we see? Well, Italian market comparing with US is tiny, because in US you have 70% of all the worldwide SPACs. If you look at Italy data, we have something like 30, but 6 of them are not targeted to retail. So for the first paper, we actually had to limit ourselves to the small number. 25% of them failed. One still were trying to look for the target, but by now I can say that they will fail because they will not find anything. So it's additional failure. We find that we just got the trading data from the Italian stock exchange, and we looked at the deal. So we got actually all the tick data, and we looked at the distribution of the data. We found that all the trading is quite small. Of course, it might be algorithmic trading going on, so all the large institutional investors split their orders into small ones, but you still have quite substantial number of big orders, but the majority is actually less than 2,000. So that's an indirect evidence that retail investors do participate in SPACs. They cannot participate in IPO, initial one, but they can buy the shares in the market afterwards, right? And they seems to be doing that. Institutional investors actually participate in the IPO. They get the SPAC shares, but what happens is that if you were the original investor in the SPAC, by the time of the business combination, so the merger, you actually try to offload the, just get out of the business. Why? Because you realize the return, you get your, of course, not spectacular return, but it's safer because if you stay with the target, your long-run performance is actually negative. So this is what happens, and the qualified investors, the institutional investors, they know about that. Some investors which didn't participate in the SPAC, they acquire the shares in the market, they build up their position, but before the merger, again, they sell the shares and they realize return because they know that whatever the target might be, it's very unlikely that you will earn money. We find that there is no SPAC mafia in US. There are lots of banks and institutional investors participating there, but it's quite a lot of them. So there are no 2, 3, 5 big players which actually govern everything. Warrants trading is quite interesting. Why investors would be participating in this SPAC listing? Well, because they get warrants. They get it for free. It's not attached to the share. So you get the share and the warrant. You sell the share, and we do find that they sell the shares, but you keep the warrant. Why? Because it's an option. If something goes well, then you receive additional upside potential for free. And that's why it's better to sell the share for a fixed amount for a small profit and then realize the higher return potential with a warrant. Of course, if you are a retail investor, you don't get the warrant. Warrants are received only by original SPAC investors. And you can buy it in the market, but this is a derivative. And of course, if you're a small investor, it's highly unlikely you understand what is a warrant, how it works, and so on and so forth. So the dilution. We find that it's not really so dramatic. Remember that in US data, they show that this number is something like 55%. Why? Well, because you have the dilution of special shares, right? If the managers, if the sponsors convert the share, you lose, because before you owned, let's say, 50% of the company. After conversion, you owe only 30% of the same company. So it's a loss. Plus warrants conversion and plus the expenses, because the company SPAC, you do have expenses. Most of the time, sponsors contribute their own money for that, but you know, to calculate the dilution, we arrived at the number which is very, very modest, 17%. So really not a big deal. Why? Because you have the long-run performance. In US data, they show that the performance of average of SPAC is really complete failure. In Italy, we show that it's not really, after comparing with IPO market of market-adjusted return, it's, let's say, 0. And the higher is the share performance, so the higher is the dilution. So dilution happens only contingently on the stock market performance. And you know, reporting this figure actually misleads the or overestimates the losses of investors because they're compensated by sharing price increase. And so that's actually where we are at the moment. We have a bit of data to work on the remuneration and put it into, let's say, academic shape and study some additional phenomenon. But SPACs seems to be quite an interesting thing. You know, after researching initial coins offerings, I thought there will be no more interesting and crazy thing than tokens offerings, but SPAC seems to be sort of on the level. And I finish here.
So let's take questions first.
I had a number of questions at the beginning of your presentation. Maybe it's an issue of clarification. So you, for example, you show the performance of SPACs, which is very low. So I'm wondering which part of this performance is due to recent decline in shares. Like
I think it's yeah.
Which part is general trend?
This is from research institution on SPACs Insider. So I didn't.
It looks very dramatic. So I'm suspecting it's due to like last couple of years when SPACs
I think so. Well, not last couple. Last year.
So you want to separate them like during decline of the stock market during.
Yeah, exactly. So for our research, we didn't find this because we looked the 1 year, 2 years, and 3 years performance, including the recent downfall. So it's much less dramatic. So here it might be more for marketing, you know.
Less dramatic. Yeah. Second is I think the slide before that you were showing number of SPACs over time. So I think another statistics that everyone would want to know is a volume in terms of dollars, as opposed to just number of those, I believe, over 1 million.
Well, if you look at the value, which I didn't report here, US, of course, it's 80%, 85% of all the value, because this is a big
as compared to IPOs.
Exactly. And both IPOs and SPACs, because in the US there is much more money. So the average IPO and average SPAC is much higher. So the value will be even more dramatic.
It is larger than IPO?
Yes.
Okay. The third thing that I noticed when you contrasting with IPOs, you mentioned that IPOs are expensive in terms of like 7%. Mm-hmm. I believe it's much more than that. It's at least for two reasons. It's underpricing that you mentioned. Underpricing is at least 10%. So
well, that was only the fee of the underwriters. Of course.
But the effective cost to the company is much more than 7%. It's 10%.
That's true. Plus you have the roadshow expenses.
Green shoe.
Yeah, green show. Yeah,
as well, which also adds another couple percent. So it's much more expensive.
That's true. Yeah.
And let me mention one more thing is out of all presentation, I found, like, I didn't know much about SPAC, but I found very surprising based on Italian data that they give warrants for free. So like we know how to price warrants. We basically see it as equity. So it's extremely strange to. I mean, you can just write paper just out of explaining why they're given for free as opposed to. And
the price is from our data, because we get the trading data for warrants. It's so the price of the share is 10 euros, and the price of the warrant average is €1.50. So you get 15% gain plus the upside, right? If you convert it. Maybe, yeah, warrants are quite interesting, because the problem is that to understand them, you have to spend a lot of time on derivatives and so on. But that's an interesting idea. Thank you.
Anyone else? Okay, let me abuse my right as a moderator. Please. And ask a stupid question. From what you have presented, I know nothing about SPACs, but it doesn't seem like a complete bubble, right? It seems like a legitimate business model. So why do you think there is such a discrepancy between the promise and the results that we see?
In the US data? Or
in the US data, and yeah, another question is why Italy is so different.
Well, because there are different regulation. There was in US in 2013 they actually changed the SPAC regulation because they realized something was going wrong. Because to dissolve the merger, if the shareholders vote against it, it's blocked. They receive the money back, but they can sell the shares and still vote for the merger. And because after the vote, the share price goes up, they keep it, sell it later on. So now these two decisions are sort of separated. In Italy, Italy is an interesting country because they surprisingly have a very good regulation. Even compared to the very developed financial markets, and they have very good reporting, so lots of data and everything. The problem in Italy that it doesn't work, so the regulation is there, but it's either abused or not implemented properly, because what we found, for example, that you are not allowed to trade shares, the shares should be stopped trading after the announcement of the merger and before the approval by shareholders to avoid this some sort of speculation. What we found in 60% of the shares, they continue to be traded because we have the trade data. We contacted the stock exchange, why is that, and we didn't get any reply. So I think here it's just the demand from private companies to get public, and SPACs were a very good solution offered by some of the, let's say, financial engineering geniuses. And before the regulation catched up, like with ICOs, like with subprime mortgages, like with tranches of collateralized debts obligations, before that, some people tried to earn money and they managed, but the rest were actually, when they were late, losing it. So my understanding here as a researcher is it's just the way to avoid costly reporting, regulation, accountability, and transparency through the usual IPO process. And that's why there was a demand from companies and there was a supply. Of course, now that the stock market goes down, there is no demand and there is no supply. So that's the only thing I think is as a possible answer.
Okay, thank you. Any more questions? Okay, I don't see any hands, so let's give an applause to Dmitri.
Thank you.
And we have a coffee break, and let's be back by 12:10. I hope that everyone who wanted to join us has already joined. Welcome back after the break. And it's a special pleasure for me to announce our next speaker, who is Daria Minina from University of Amsterdam. We've been following Daria's stellar career for a while now. We are proud to have her as one of the students of BEROC student, and I think postgraduate school as well. Yeah, so, well, now Daria is well behind that already. Well, we are pleased to have her here as a grown-up researcher already.
Thank you very much for the kind introduction. And also, first of all, thank you organizers for giving me the opportunity to present here. Today I'm going to present the project, the path-through from inflation perceptions to inflation expectations. This is joint work with Stephanie Huber from University of Amsterdam and Tobias Schmidt from Deutsche Bundesbank. As Tobias is from the Bundesbank, the usual disclaimer applies. So this is an ongoing research, so we would be very happy to hear your comments, questions, and feedback. So the motivation for our project comes from like two directions. The first is the survey data. Here you see in blue the mean inflation expectations and in orange mean inflation perceptions. But first of all, let's agree on the terms. What I understand by inflation perceptions. That's the answer to the survey question, what do you think the inflation rate over the past 12 months was? So this is what people perceive the current inflation is. And expectations is their forecast for the next 12 months. So here you see that these two lines move very closely together. So, and if we add the CPI, which is now in red, especially in low inflation environment, which was, so this is German data, which in Germany was until the end of 2021. So these two were moving more closely together than they both did with CPI inflation. Now it's no longer the case, but for the low inflation environment, it was the case. But the thing is, they move very closely together, and this is true not only in the Bundesbank data, but everywhere in surveys in general. The second direction of our motivation is the importance of inflation expectations. So they have been shown to influence consumer spending. They, even in the low inflation period, they were important in policy discussions because of the management of inflation expectations. But now, when inflation started to get really high and volatile, the anchoring of inflation expectations have come to the forefront of policy discussions again. So the broad question that we ask in this paper is, how do inflation perceptions relate to inflation expectations? I will very briefly say about the literature that mostly the literature either focuses on solely expectations, the biases in them, that people are wrong, that there are socioeconomic differences, especially between females and males, etc. And the same, there is a much smaller, but there is a strand of literature on the perceptions, but not so much about the link between the two. So there are some papers that state that the correlation is very high, but they don't go further than that. So we want to contribute here to look in detail into this link. So in particular, we are interested in, do perceptions causally drive short-term expectations? And whether perceptions influence long-term expectations as well. Then we want to understand how households form inflation perceptions. If they are very important for expectations, then it's a natural question to ask what goes into inflation perceptions of people. So then we want to find the factors that drive this link between perceptions and expectations. And finally, what about the policy? What are the implications? A quick preview of the results. So first we find that households' inflation perceptions, they causally drive their expectations. So we first do various OLS estimations, panel regressions, and there we cannot make causal claims, but we conduct an RCT information provision experiment in this survey, and there we are able to establish the causal link. Also, what is important for policy is that perceptions matter for long-term expectations as well. So there is a question for anchoring of long-term expectations because perceptions feed into them as well. Then we find that the most salient and frequently bought items like food and fuel are very important for perceptions, but also the uncertainty, especially during the war, influences heavily inflation perceptions of people. Then we found that different socioeconomic groups rely to a different extent on their perceptions when they form expectations. So there is socioeconomic heterogeneity. And also this link is different between low and high inflation periods. Finally, we found one factor that is important for the strength of the link between perceptions and expectations, and this is the level of uncertainty. So first, let's talk about the data. We used the Bundesbank online panel of households. This is a monthly survey. There are more than 2,500 individuals participating every month. There is a large cross-section, but there is also substantial panel dimension. So we can also run panel regressions and control for individual fixed effects. The survey started in April 2019. There are 3 waves in 2019. And from April 2020, this is an ongoing monthly survey. Regarding inflation perceptions, there is one question which we are going to use. This is a quantitative question. It asks, what do you think the rate of inflation or deflation in Germany was over the past 12 months? This is what we are using as inflation perceptions. And there are a bunch of questions on inflation expectations. There is a qualitative question where the answers range from decreased a lot to increased a lot, which we are not going to use in this project. There is a quantitative, which is like the main question that we are going to use. It asks, what do you think the rate of inflation or deflation will be over the next 12 months? And also there is a probabilistic question. So it asks, it gives, I can now show you how this, so this is how this question looks like. It gives the bins of potential inflation or deflation, and people have to assign probabilities. So this is a very important question to ask, because from this we obtain the subjective probability distribution, and we can obtain the mean, the median, and what is very important, the standard deviation of variance, which we are going to use as the uncertainty about future inflation. So this is what we are going to understand under uncertainty. So our first question, how are perceptions and expectations related? So first we run a bunch of OLS regressions in cross-section. So we run the regression of expectations of a household on the perceptions of this household, and with a bunch of socioeconomic controls like gender, age squared, education, employment status, income, region of Germany. And we also control for the survey wave fixed effects. So, and this is the first 4 columns of this table present the results of the OLS regressions. The fullest specification is column 4. Everywhere we see that the link is extremely strong and robust. The changes in perceptions transmit almost one-to-one into the changes in expectations. Also, we can, because there is a substantial panel dimension, we can control for individual fixed effects and run panel regressions. And also the last column is like the change of expectations of an individual I on his or her own change in perception. So it's like a change on change regression. So these 3, 5, 6, and 7, the columns are the closest to causal statement that we can get so far. So the conclusion from this is that perceptions are extremely important. They have a positive, large, and significant effect on households' perceptions. If we plot the regression coefficient by wave, then we can see, so here there are 33 waves of the survey. It is high at all times, but it is much higher in low inflation environments. So this is the first roughly half of the waves. Now, when inflation started to become more high and volatile, the reliance on perceptions decreased. So this is what we are going to test more formally. So here we split the sample into before July 2021, we call it low inflation environment, and after July 2021, we call it a high inflation environment. We run the sample splits, but also we control by introducing the interaction term between perceptions and high inflation dummy. So this is the column 5. And here we see that the link between expectations and perceptions decreases a lot during high inflation periods. So this is very much in line with rational inattention type of theories, where in times of stable and low inflation, there is no incentive to search for correct information, and inflation is not in the news anywhere. So people rely on their consumer baskets because that's the free source of information that they have. But in the high inflation environment, first, inflation is in the news everywhere, and also it makes more sense, it's more valuable to obtain correct and accurate information about the actual inflation. So now the question is whether perceptions matter for long-term expectations as well. We have 2 questions regarding the long-term expectations over the next 5 years and over the next 10 years. So here you see how they look like. The medians are in dashed lines and the solid lines are means. So they were pretty stable, but starting from the war, they increased quite a lot, both 5 and 10-year had expectations. So both medians and means. So what we did, we ran the regression of long-term expectations on perceptions and also controlled for short-term expectations. Even when we control for short-term expectations, perceptions still matter. So the changes in perceptions, they also matter for long-term inflation expectations. So this kind of raises a question of how well anchored the long-term expectations of German consumers are. So inflation perceptions also matter for long-term expectations. Now, all that we did was correlational evidence. We wanted to obtain a causal link. So the idea is to induce an exogenous variation in perceptions and see how much it will transmit into people's expectations. We implemented this in August wave 2022. We allocated people into 4 groups. 1 control, they received no information. And groups 2 to 4, they were treatment groups. They received different information about the official rate of inflation. And also they received a reminder about their perception of inflation. Now a bit more about the timeline. So first we elicited pre-treatment quantitative perceptions and expectations, standard questions that I showed you before. Then we did information provision to these 4 groups. And then we elicited post-treatment perceptions and expectations, but in slightly different form, because we cannot ask the same question that we asked before. People are going to be anchored on their answers before to be consistent. So our information treatments. The first treatment, we provided them the CPI inflation in the previous months, which is 7.5. The second treatment, so here we provided the harmonized CPI, which was slightly higher, 8.5 at that time. And because we provide people with CPI inflation, we cannot ask them their perceptions, because we ask, what do you think the rate of inflation over the past 12 months was? And we provide them this information. So we made this assumption that people adjust their perceptions to the provided information. And naturally, for part of the people, our treatments are going to be good news if they have higher inflation perceptions before. But for some people who thought that inflation was lower, this was a bad news. And the third treatment, there we provided the people with inflation, excluding energy and food, which was much lower than the 2 numbers shown before. So it's 3.2. And in this group, we also asked post-treatment inflation perception, because we didn't provide inflation directly. So how did we ask post-treatment expectations and perceptions? We cannot ask the same question because of the survey fatigue, and also people want to be consistent. We asked the standard min-max question, which is typically used in this type of RCT experiments. So we ask what are the minimum and maximum values on inflation you expect So like the lower bound and the upper bound, and then we ask for the probability that inflation will be higher than the midpoint of the interval. If we make an assumption of a triangular distribution, which is usually made, then we can obtain mean, median, and also the uncertainty. So here the first result, here we split the sample into people with perceptions, prior perceptions, which were higher than 8.5. For them, all the treatments were good news. And for people for whose perceptions were less than 4, likely all of the treatments were bad news. So in here we see that in the good news group, the expectations and perceptions all adjusted in the right direction. So they adjusted the perceptions and expectations downwards. And the opposite is true for people for whom the information was bad news. How do we want to use this RCT to make a causal claim? So we run the regression of the change in expectations post and pre-treatment on the perceptions, the difference between post and pre-treatment, and controlling for various socioeconomic characteristics. And this is the result that we obtain. So the first column is all the pooled groups, and then all the treatment groups. And here we see, although the coefficient is lower than it was before, still there is a substantial, sizable, significant effect, which we can now say that it's a causal effect of perceptions on expectations. Now that we know that perceptions are important, it's also a natural question to ask what goes into formation of people's perceptions. We, in April wave 2022, we ask people what are we'll give a list of factors, and we ask people to rate the importance of these factors. And here you see the results. This is the share of people reporting the factor to be very important in their inflation perceptions. And here, first of all, the frequently bought items and the most salient items like food and fuel are on top, and also the war in Ukraine, which is also partly correlated with food and fuel prices, but also with the significant uncertainty. So these were the top 3 factors that were the most important for the formation of people's perceptions. Now we wanted to ask if this link is the same for everybody, or some people rely more on their perceptions and some others less. We did sample split regressions and also included interaction terms, and we find that there is substantial heterogeneity. The link is stronger for women, for residents of East Germany, for employed, for low educated, for younger than 60. So we see that there is heterogeneity, and also we saw the heterogeneity between high and low inflation environments, and this can give us hints about what might be behind this. We wanted to look at 2 potential factors that might drive these differences. First, information sources. So different socioeconomic groups might have different information. They might be informed to a different extent. And also different levels of uncertainty about inflation dynamics might be important in that. So first, about information. We asked 2 questions in July 2021. So this was the month when inflation started to increase, but not crazy high like in the beginning of 2022. So first question proxied the degree of informedness that people have. So it asked, aside from the survey, have you heard or read anything about inflation over the past 4 weeks? And here the split is almost half-half. Half have heard or read something about inflation. But when we ask, what do you base your perceptions on, something you have heard or read, or your own shopping experience, then it's almost 90%. Although they have heard or read something, they rely solely on their own shopping experience. So, which also correlates with the finding that for perceptions, the food and fuel were extremely important. Next, we wanted to see if information matters only for perceptions, for expectations, or for the link between the 2. Here, when we run the regression of expectations on perceptions and also for the information variables, when we include perceptions, information variables stop being significant. So they matter for perceptions, and through perceptions they affect expectations. There is no direct effect. So here it is worth noting that it's only one wave. This is low inflation environment. We already re-elicited this question in November wave, but we don't have the data yet. So later we are going to be able to say something about how it changes between high and low inflation environments and whether this is the robust finding or not. But for now, we can say that both information variables have effect on perceptions, and through perceptions, they affect expectations. The second potential factor that might be important is uncertainty. Uncertainty, here you see the standard deviation from the probabilistic question that I showed you before. In blue, this is mean, in orange, the median. And so we are going to use it as a proxy of uncertainty. So first of all, there is socioeconomic heterogeneity in uncertainty. Here you see it based on income. The lowest income group, which is in blue, it has substantially higher uncertainty throughout the whole period. And the same is true for women, for low educated, for residents of East Germany, and for the younger. And here we can see a significant overlap between these groups and the groups that relied more on their perceptions when they formed expectations. So first we split the sample into the quartiles of uncertainty, the bottom quartile to medium quartiles and top quartile. And then first of all we run the regressions based on sample splits. And here you see that for the lowest and the highest uncertainty, the link between perceptions and expectations is higher than for the intermediate. When we include the uncertainty squared and the interaction terms with uncertainty and uncertainty squared, then everything is significant and the coefficients on the interaction terms are of different signs. So we can say that there is a nonlinear effect on the pass-through. So people with the lowest and the highest uncertainty, they rely more on their perceptions, while in the intermediate region, this reliance drops. So the uncertainty matters for the pass-through, and it matters in a nonlinear way. To conclude, we find that inflation expectations are very much reliant on inflation perceptions of people. Inflation perceptions matter not only for short-term, but also for long-term. Excuse me. In the information provision experiment, we were able to show that perceptions causally drive inflation expectations. The most important factors for perceptions are people's consumer baskets, and particularly the most salient and frequently bought items like food and fuel. And we find that the pass-through strength varies by low and high uncertainty, and also by the low versus high inflation environment. And what are the takeaways and policy implications? If inflation expectations are to a large degree pure extrapolation from their perceptions, how can we manage expectations? Maybe we can correct the wrong perceptions that people have, because perceptions are very much away from what real CPI is. Even if we control for differences in the consumer baskets, people still are very wrong. So can we manage inflation perceptions of people? Can we try to correct this wrong information that they have? Our RCT provision experiment says yes, because that's what we did. We provide them with current inflation information, and both perceptions and expectations moved in the required direction. But in reality, households might be harder to reach. And also regarding the current situation, now, especially when the food and fuel prices are very high and volatile, and these are the factors that are most important for people's perceptions and thus expectations, there is a risk of the anchoring. Sorry.
questions.
Is it okay, Daria?
Yeah.
Great. I have two questions. The main one, you actually rely on one-sided causality from inflation perceptions to inflation expectations. Are there any grounds from your perspective to think about more complicated causality that can also at the same time stem from inflation expectations to inflation perceptions? Can you think in this direction? And the second one, I think it is more simple in terms of policy perspective. Would it be fair enough to interpret your conclusions that the problem is not inflation perception themselves, but so-called wrong inflation perceptions, as you told, and we should think in from a perspective of manipulated inflation expectations, we should think and focus on matching inflation perceptions to the actual level of inflation. Will be this fair interpretation or not?
Sorry. I tried very hard not to cough during the presentation, but didn't manage to. Okay, first question about the reverse causality. I'm aware of only the one paper that shows that there is such a link, and this was not a very robust finding. It was, the logic was something like a self-confirming bias, but it was not shown in many other papers. Technically, we can test it because, for example, the war, it presents a shock to inflation expectations, but not to inflation perceptions, because it hasn't appeared in the prices yet, for instance, in February, but it's already a shock to expectations. So if we, So if we compare people before the war and just after the war, then just after the war survey, they have already this shock included, and we can test how much the effect on perceptions is. But we didn't do this. We focused only on this direction, and that's what we're aiming in our RCT, but that's a valid point. And can you repeat the second one?
Policy interpretation of your conclusions. Would it be fair to say, based on your conclusions, that from policy perspective, we should focus on the deviation of inflation perception from actual inflation rate? And this should be a target for policy communications.
Yeah, I think that's our conclusion. In RCT, we showed that that's possible. Like, well, first of all, in our project, in this data, we are not able to obtain the real CPI that people face. We have the share that people spend on different goods, categories of goods and services, but the CPI, the just overall CPI, doesn't convey all the information. So different, especially low-income groups, they have been shown to face substantially high inflation. So we definitely have to correct for that. So if we provide people with just this number of inflation, then probably it will be an underestimation for some groups of people. But also, there is such a large variety, like dispersion of perceptions. It goes from like -30 to 100. So potentially the least financially literate and the least educated people that have like these crazy high expectations, they can be brought to a more reasonable inflation perception. So yeah, I think that's a question worth studying, but it's not something we can conclude, but that there is a nudge in this direction. So if perceptions are wrong, then maybe it's worth spending some effort not doing like the forward guidance, but also to inform people on the actual inflation and maybe on the composition of consumer basket, how it's computed, because people over rely on the most frequently and salient items. Yeah.
I have very general question from presentation, also not in the area. So isn't it kind of strange time and country to study inflation expectation? Because just a couple of years ago, inflation, I believe, in Germany was about 1-2%, and it was flat expectations, so they always were right. And now we're looking at the time when inflation is relatively high and uncertainty is much higher. So kind of isn't the last couple of years, isn't it a very special experiment because it's in Germany and because it's a volatile time?
Okay, so maybe Germany is special, but in the first half, the CPI inflation, you can see it in red, it was very low, and still perceptions and expectations were very high. Like, well, they were much higher than, so people were wrong in their perceptions. And also, yes. Yes, that's a general finding in the Michigan survey, in the New York survey. Yes, so here in this respect, Germany is not very special. Maybe it has more trust in central bank. Well, it in some surveys it shows that Germany has a bit more, but it's not something very very strange. And yeah, because here we see that expectations and perceptions move very closely together, even when they are very far from CPI inflation. So there is something that drives them both, and I think this is not a German phenomenon. This is a general finding, general how people perceive and form inflation expectation.
As a non-economist, maybe I have a very naive question. In finance, we have lots of surveys data, but the targets are actually not consumers, but the professionals, the industry, businesses, and everything. So I'm just wondering if consumers are always household wrong. Is there data on business expectations of inflation, and maybe it will be much more? Do you have evidence on that?
We don't in this project. There is a Bundesbank survey of firms, and there is also survey of financial professionals. And in general, the findings for firms are that they are somewhere below, between the consumers and financial professionals. There is less disagreement, and they are closer to actual inflation, but still they are wrong. They are uninformed and inattentive. So yes, it's not that crazy as for the consumers. Sometimes it's very far off, but firms also get it not very right. But we don't have usually the data on perceptions of firms. There is data on firm expectations, but not what firms, in some surveys there is, yeah, but not in all. For instance, in Bundesbank, they ask only like 2 times. So in general, they are much more interested in their expectations.
Okay, and well, maybe the last question from me. Do you know who are these 11% of people who do not have information from their own shopping experience? And do you actually ask people whether they do the shopping or it's someone else in their household? Do you have data on this?
Yeah, so we have data about this, but this is a very small group. So I don't think a lot of conclusions can be made from it. But we didn't look in very much detail because we are going to analyze it with the November wave. There will be a larger sample, and then we can say something. And there is information about who is the main shopper, but I think it's not in all waves, and we didn't use it in the experiment. But yeah, I think at one point I also tried to look whether they have the main shoppers have a high link between perceptions and expectations, but it's not in the project. It was just one result that we once looked at. But there is such information. We can probably utilize it more.
Thank you. Yeah.
Thank you, Daria. I also wanted to ask you just a technical question, like from your results. You consider like low, high inflation environment, and then you consider different quartiles of distribution of uncertainty. So why in one instance you test the results by using interaction, and in the second you just split the sample, because you cannot directly compare these coefficients when you split the sample? When we talk about uncertainty. And how do you measure uncertainty actually, where the data comes from?
So uncertainty we measure from the probabilistic question. 1 second. So that this is this question, and from this, this is the variance. We have the subjective probability distribution, and we compute the mean, median, and the variance. Regarding the differences between the two, so in high and low inflation, it was logical for us to split it kind of into 2 periods, like to make a dummy, but also I include we test the interaction terms, and we do the same with uncertainty. But I just presented the sample splits because it's kind of, you can already see in sample splits that it drops. And it is confirmed by adding the interaction terms as well. So we have it in the paper, but not here, because it's much more evident in the split sample the results of this nonlinear relationship.
And would you expect actually the results to differ in the environments where, for example, governments do not use inflation targeting as a monetary policy? I think it can go in various directions. I know one paper that compared the Argentina and high inflation environment and US and low inflation environment, but to be honest, I can't remember where the link between perceptions and expectations was higher. So yeah, but they tested it kind of the Bayesian updating and where the priors are stronger and where they're weaker. But to be honest, I cannot speculate where. It would be interesting to see it in some high inflation and volatile inflation country. But the trust, and then also there might be problems with the correctness of CPI data and everything. So it would be a bit difficult to test.
Okay, so no more questions. Let's give an applause to Daria. And our next speaker is Igor Livshits. He's a guardian angel of BEROC, and our academic advisor. So welcome, Igor. Thank you.
Thank you. And thanks everyone for being here. All right. Wait, how do I find my presentation? I can see it. You can't. Yeah, there we go. Oop. Let's get back. There we go. I'm more than happy to be interrupted during the talk. For the sake of any Zoom participants we may have, I'll repeat questions if I get them along the way. The work is joined with Natalia Kovrizhnik, who is at Arizona State, Yuri's colleague, and Daria Zetland-Jones, who's at Carnegie Mellon. I'm at the Philly Fed, so I do have to say that these views are ours and not necessarily those of the Federal Reserve Bank of Philadelphia or the Federal Reserve System. And let's get into it. So what we're going to be talking about is very early stages of credit life cycle. So ultimately, the topic of the conversation is access to credit. I understand that in a world where some people have trouble accessing their own checking accounts, accessing credit might seem like a second-order issue. It is a little bit of a first-world problem, but I'm going to proceed under assumption that it is an important first-world problem. because accessing credit may be important for ability of households to smooth income shocks, smooth expense shocks, smooth intertemporally. Buying a house typically requires a mortgage in most countries. So I'm going to take for granted that access to credit is important for borrowers, and what I'm going to focus on is the very early stage of building this access to credit. Now, I have a lot of experience in this because I had to build my credit history in North America 3 times. When I first moved there for graduate school, then I moved to Canada, and I had to start from scratch. And then 5 years ago, I moved back to the States, and I had to start from scratch again. It's been a lot of fun, because every time you get this rejection letter from a credit card company going, "Nah, your credit history is too short." Like, well, that's a little bit of a catch-22. You can't build credit history if you don't have a credit card. And you can't get a credit card if you don't have a credit history. So this is kind of, that is what we're going to talk about. So basically, the normal view of credit history in the literature is, well, the credit history is history of repayment of loans. What we want to emphasize, what we think is very important at the very early stage, what I personally think is very important at the early stage, is even the fact that somebody else gives you a loan may be informative. So we're going to focus on this other aspect of credit history, which is history of borrowing per se. All right? Now, yep, that's it. What we're going to do is we're going to start with showing some very basic facts. So we got a new data set, which is really cool. And we're going to document some facts that are not surprising and some facts which we find very surprising and motivate exactly what we're... Again, we came from it from personal perspective, but turns out that holds up in the data more generally. And what we're going to document is that lenders, when it comes to very new borrowers, lenders seem to actually react positively to a borrower taking on another product, another credit card. It's not the case for established borrowers, but when it comes to new borrowers, somebody else giving you a loan is a good signal to lenders, which kind of goes against the traditional view of debt dilution, which is if somebody else gives you a loan, that's bad news, because you're now more likely to default on me. So when it comes to emerging borrowers, we're going to document these new facts. And then we're going to interpret these facts that we're going to document as there is some what we call information aggregation across lenders. Some lenders know something about you that other lenders don't. And you taking on a loan conveys that information to other lenders. We're going to write down the most basic theory the most basic model we possibly can to capture this story. That most basic model is going to be it's going to be very stripped down, but still annoyingly complicated in a way. But we're going to learn a few things from the model, and the model is actually going to give us some testable implications that are not obvious ex ante. We're going to take those to the data, and turns out the data is going to support those, again, for emerging borrowers. So let's get into what emerging borrowers are and what the data are that we're using. So, as I said, we kind of started from this personal experience, and actually, let me be honest, we started with the model. We wrote down this model, we started presenting it. People said, "There's no way that's in the data." I'm like, okay, let's go by the data. This was before I joined the Philly Fed, so we didn't use the Fed data, the consumer credit panel that's available at the Federal Reserve. We went and bought the data from TransUnion, which is one of the 3 major credit reporting agencies. So it's custom-made data set, where the key thing is we asked TransUnion to give us 500,000 people who are new to the credit market. More specifically, their oldest credit trade is no more than 6 months old when we first see them in September 2014. So that's our study sample. Those are people we're going to call emerging borrowers. And then to have a control sample, we have another 500,000 people who are just representative population of everybody else. So they're taken to represent the credit score distribution in the country. We see them 4 times, every time in September, 2014, 2015, 2016, 2017. So we're basically just going to track them over those years. The key thing about the data is we're able to keep track of individual credit cards. It's not aggregated to a portfolio, it's literally we can track individual cards. So we'll be able to talk about responses of lenders to news about the borrowers. All right. So
what are some basic facts? If you see all those buttons, I can tell you a lot more, ask me. But what are the basic facts that I'm going to take as motivating evidence? Let's go with 4. First, emerging borrowers' credit limits grow a lot more than those of established borrowers. Duh. These people are new to the credit market, they're growing. I mean, they start from a very low base. They don't catch up in 4 years. There's still plenty of room to grow. So that's really not surprising. Second fact is even less surprising. People who open a new card have their credit limit expand more than people who don't open a new card. Duh. Let's get to the interesting part. People who get a new card, a very large chunk of their growth in credit limit comes not from the new card, but from their existing card. Of the 200, so let's focus on the emerging for a second. People who get a new card had tripled their credit limit. Great. But the credit limit on their existing card more than doubled. So 2/3 of the growth in their credit limit came not from the new card, but from their existing card. And that's fact number 3. Fact number 4, that is much less of a case with established borrowers. So established borrowers who got a new card saw a 31% rise in credit limit. Only 5% of that, only 5 percentage points of that came from the existing card. So, in fact, let me kind of flesh that out a lot more. Let's look specifically. So what we're already getting at is existing lenders seem to take it as good news when emerging borrowers get a new card. Let's time it. This is kind of almost an event study type thing. This graph, I am now restricting the population only to those who got a new card. Some of them, so I see people only in September. We didn't have enough money to buy a full panel, but we can still do this. I see the first time I see people is September 2014. I'm going to now look at September 2015, and I'm going to say, okay, some of these people have already got a new card. I also see them in 2016, so I also know that some of these people will get a new card shortly thereafter. So that's how basically breaking things down. These are people who got a new card exactly in September, in August, in July, in June, and so on. So this is months since they got a new card. To the left of the dashed line, these are people who haven't yet got a new card, but they will in the coming months. So what we're trying to get at here is there's a very discrete jump. Sorry, and what we're plotting is the change in percentage points in the incumbent, in the existing card's credit limit. So existing lender, the lender you had back in 2014, they discontinuously increase the credit limit the minute you get a new card, long before you had any time to establish repayment history on it. So when it comes to, and sorry, the blue points are emerging borrowers, gray points are established borrowers. There is some action for established as well. It's not nearly as big as for emerging. So for emerging borrowers, if a lender sees you get a new card, they go, oh, somebody else has something good to say about you. Somebody else is willing to give you a loan. That's good news. All right? So that's my motivating evidence. I'm happy to talk more about what it's not about. So there are other potential explanations besides this information aggregation. We try to control for those. You didn't ask me about them. You'll have your chance later, maybe. So what am I going to take away from this? I'm going to say, hey, I think I see evidence of information aggregation. I think I see evidence that when a lender, let's give some lenders some names. Leva's going to be my lender. Nothing personal. You're just, oh wait, I need 2 lenders. Who's my second lender? Alex is giggling, so he's my second lender. You want to be my lender? No.
Clarifying question. On the previous graph, the emerging borrowers
So the entire sample, sorry, the question was emerging borrowers on this graph who haven't got a new card, what's happening there? So let me walk a little bit more slowly through this. Emerging borrowers are people who in 2014, the first time we saw them, their oldest credit product, it's called a credit card, was no more than 6 months old. So I label you emerging once when we first get our data, so 2014. This is based on 2015 September. So in 2015 September, so what do I want to, I only see the credit limits on the cards, not every month. I know when you open the card month by month because of the nature of the data. I don't see the credit limits month by month. So the way I'm going to do this exercise is I'm going to go in September 2015 and look at those emerging borrowers, sorry, those borrowers who were emerging in 2014. They had a credit card in 2014. That's a part of the selection, sample selection. And I'm going to say, what happened to the credit limit on that old card? On that new card. On the card they had in 2014, their first credit product. Now, I want to compare as much apples to apples as I can. So some people have, let's say, liquidity needs. They go and search out cards. So what I want to do is I want to make sure that people who got a new card recently, I'm comparing to somebody very similar. How am I going to do this? I'm going to say, since I have data from 2016 as well, these people will open a card or do open a card right after that September of 2015. So these are people who haven't yet opened the card when I see their credit limit on the existing card in 2015, but they will do so in the coming months. So these people have basically the same liquidity needs, roughly speaking, as these people. So everybody on this, in this graph opened a new card between January 2015 and I think it's like April of 2016. And what but I only see their credit limits in September. So that's why I'm using that's why it's a little bit awkward. But people who have already had their new card show up on their credit record, so that's why there's like a 1 month delay. It doesn't jump at 0, it jumps at 1. It takes a month for the new card to show up on the credit record and for your lender to respond. All right.
Two questions. One clarifying. So how the banks get the information about the card? Is it like the monitors, they have to incur some cost of monitoring, or is it automatically?
And the second?
And so the second is more like comment. So don't you worry here, so this is unconditional jump, right? So this is just increase. So don't you worry that like banks have some amount of limit in mind, and those who establish already have very close to this limit, and therefore the jump is very tiny. But those who just knew, they're like, oh, okay, they have $100 so far, and the bank has in mind like 1,000.
So let me, first question was, do banks actively monitor this? Do they automatically get notified when you open a new card? No, they do have to do this somewhat actively. I'm surprised there is such a discrete jump because frankly, I thought they would have paid attention like every 3 months. No, this is really immediate. So I'm guessing that when it comes to very new borrowers, they pay attention a lot more than, generally the bank seems to pay attention, judging by how often they adjust credit limits, they pay a lot of attention in the first 12 months of a product. The second question was, do the established borrowers see smaller jumps simply because they're already close to their like true borrowing limit? That's possibly. So my biggest thing is it's kind of, I don't want to compare the sizes of jumps, but it's also, these are, in terms of dollars, this jump might be just as big because these guys have much, much, much larger, I mean, I'm not going to show it to you, but in terms of relative magnitudes of credit limits, these are 10 times those. Typical credit limit total of an established borrower, 20,000. Typical credit limit of an emerging borrower, 2,000.
No, I think like this graph looks cool, but I think like for established it's way more convincing. Like, you know, the fact that you see it for established, it's already
Yeah.
of the convincing of the math.
I understand. I understand. Some of the other things will. I'm happy that you're happy. So let me take that as given and now write down a very, in the nicest way possible, dinky model. Meaning, I'm going to write out the most stripped down model I can to capture this story. All right? So let's get into it. How am I doing on time? All right. This is going to go fast. What is the absolute minimum I need? I need borrower. I need at least 2 lenders because I need dispersed information. I need time to build credit history, but doesn't mean I want to deal with multi-period thing. So I'm going to cheat. I'm going to say there are 2 periods. There's only one. There's a borrowing period and repayment period. Since I want a credit history building within the borrowing period, I'm going to break up borrowing period into 2 stages. So the whole idea is there's no consumption between stages. I'm just going to give you a chance to build credit history. Second period is going to be tremendously boring. All the action is going to happen in the first period, and first period is broken up into 2 stages with no repayment in between. This looks like a terribly busy slide. Borrowers, I'm going to make borrowers as boring as I possibly can. So what do I need from borrowers? I need from borrowers for them to be risky and heterogeneous so that there is something to learn. So how am I going to generate? And I'm going to make them hungry so that they actually want to borrow. So how am I going to make them risky? I'm going to say, well, they have uncertain endowment in the second period when they're going to repay. So some of them will repay, some of them won't. And there are 2 different underlying, I'm going to call them states. We run out of words. Good and bad, G and B. Good borrowers are more likely to have, good borrowers are more likely to have high realization of endowment tomorrow. That's what we're going to be learning about. That's what everybody in this economy is going to be, in this game is going to be learning about, those 2 underlying states. What else? The borrowers exposed, if their income is too low, they're just not going to repay their debts. And if they don't repay their debts, the lenders don't get paid back. There is no partial recovery. And we're going to make very simple assumptions so that it's very clear what the there are only 3 possible realizations of endowment, low, medium, and high, which means there are 3 possible natural loan sizes. Phi times AL, that's small loan, phi times M, that's medium-sized loan, and phi times AH is the largest loan possible that could ever be repaid. Is that it? That's it. Borrowers could potentially be risk-averse and patient, but that gets really annoying even in a simple model, so we're going to shut it down. Illustrative example is going to have borrowers who really hungry and don't really care about risk. All right, so all of the action is going to be on the lender side. Even the information, as I said, it's important for me that we're aggregating information across lenders. I'm going to endow all of the information into lenders. Borrowers don't know anything. They're going to learn from the lenders. Okay, so lenders have information and lenders are going to make loans. What information do they have? Lenders first of all, I really want to have 2 lenders, but if I literally have 2 lenders, one of them becomes a monopolist once they learn information. I don't want to deal with that. So I'm going to clone my lenders. I'm going to have like purple lenders on this side of the room, yellow lenders on the other side of the room. I'm going to forget those colors later. All of the purple lenders get one signal. All of the yellow lenders get another signal. So that you all yellow people are competing amongst yourselves, as do the purple people. You don't see each other's signals. You all know that every purple person has the same signal, but you don't know what the yellow signal is. The only way we're going to aggregate information is you're going to get to see who I got a loan from and what loan I got in the first stage. So there is this technology of public record keeping where you get to see my loans from stage 1. And I'm now a slide ahead of myself. What did I forget to tell you about the borrowers? Sorry, the lenders, nothing else. Lenders are otherwise lenders are perfectly standard, they're risk neutral, they have access to exogenous risk-free rate. So that's where I was. I gotta start looking at the screen. Right. So first stage, all lenders know are their own signals. They make offers. What are offers? It's the loan size and the loan price. So X is how much I promised to repay. Q is per unit price of that. So if I take a loan from you, I take QX today and I promise to pay X tomorrow. What goes into the credit record? The entire thing. How much I borrowed, at what price, and from whom. Frankly, is that what I see on the credit record? No, not quite. But it makes my life in the model a hell of a lot easier if I can just record everything and then I don't have to worry about me coming to Lev and go, hey, Lev, why don't I give you a couple of bucks so that you pretend to give me a loan so that those yellow people think you like me. So let's just rule that out. I'm going to see the prices. I'm going to see what color lender the loan came from. All right. Second period, as I said, is boring. We realize my endowment and we realize whether I pay my loan back or not. Just a quick note. The reason I'm calling this actions is this is a game. So it's not an economy, it's a game. With that in mind, these are payoffs in the game. Nothing unusual here. Really, all I care about as a borrower is how much I get to consume today, which is how much I borrowed in the first stage plus how much I borrowed in the second stage. Tomorrow I make a rational decision whether to repay or not. Lenders just care about profits. Expected profits. All right. We already talked about the kind of three natural loan sizes. In fact, increasing the loan, any loan below phi-EL is risk-free. Any loans in this interval between phi-EL and phi-M have exactly the same probability of repayment. So we're not going to ever end up anywhere in between. We're just going to end up with one of three possible loan sizes at every stage. So we're just going to restrict attention to that. All right. You don't need my annotation. I do need to spend a minute on this. This is a game with both signaling and screening, which means, well, by the virtue of this being a game with signaling, it has gazillion equilibria. So I have to employ some selection criterion. What we really wanted to do is employ Chow-and-Krebs intuitive criterion because it's the natural thing to do. This game has a few too many stages for Chow-and-Krebs to apply directly, so we're just gonna basically modify. We called it intuitive-ish for a while, but that didn't stick. So we're just gonna basically pick an equilibrium, very much in the spirit of Chow-and-Krebs. It's the equilibrium that's most preferred by the best type. Type. The reason I called there was this underlying state of the borrower, G or B, good or bad. Nobody knows that state. So I'm not going to even talk about it anymore. The relevant type of the borrower in the game are the signals. So there are borrowers who are AA. They have A from the purple, A from the yellow. Those are our best borrowers. That's the best type. There are ABs and there are BBs. The equilibrium concept, as I said, in the spirit of Chow-and-Krebs or in the spirit of Miyazaki-Wilson allocation, it's the equilibrium most preferred by the best type. So it's the equilibrium that's it's the perfect Bayesian equilibrium that's most preferred by the AA borrowers, and turns out the off-equilibrium path beliefs you need to support it are indeed very intuitive. So, all right. I have 13 minutes? Oh, I'm doing fine. So, what does credit history look like in this model? Well, credit history is, step back, in all of the intuitive-ish equilibria of this model, the only way we get any action in stage one is if a positively informed lenders, make an offer. Why? Because generally, making a loan in the first stage is a bad idea, because there's a second stage and somebody else is going to come around and top up the borrower with another loan, which means you're going to get diluted. And now, as a lender, you have to price it in, which means you can't really offer a very good price. So lending in the first stage is not a natural thing in this environment, except for to aggregate information. So what's going to happen is, if A lenders offer a loan in the first stage, I as a borrower may take it with the sole reason to convince the other lenders that you guys had good information about me. So I'm decided purple, what people are going to be, you guys have a signal about me. Now, first of all, when I woke up this morning, I didn't know what type I was. What do I know? I'm a borrower. I have no experience. You guys are lenders. You know what my probability of repayment is. The way I learn is I learn from your offers. If I wake up, I see all these offers from purple lenders and go, okay, purple people have a positive signal about me. They're A. If I see no yellow offers, they don't have a good signal about me. I now learned that I am an AB borrower. Okay. Now, if all of you guys have good signals, I learn I'm the best type. Now it makes sense for me to take an offer from one of you to convince the other one that I am indeed AA. Okay, and that's what I'm going to call credit history building. No, I'm not going to have it. Let me leave this on for a second. In a bunch of our equilibria, not always, AB borrowers will also take a first stage loan. AB borrowers are not going to convince. So you guys have A signal, they have B signal. If I take a loan from you, they still think I'm AB. I haven't convinced them all that good. I could just stick with you guys, your A's, even if you presume the worst case scenario that those guys are B's, you're still going to give me an AB loan. You're happy to give me an AB loan. So as an AB borrower, I don't do credit history building, but I may still take a first stage loan. Why? Because it might be at a good price. When is that at a good price? If AA borrower is so high quality that even with that dilution, there's still a better risk than AB, it might make sense for AB to go, hey, I'm not going to convince them that I'm AA, but the offer you're making in the first stage, you don't know who you're making it to. It's this weighted average of AA borrowers and AB borrowers. And if AA price or probability of repayment is better than AB price, then ABs will take it just because it's priced well. So there's maybe this cross-subsidization equilibrium. There are equilibria with cross-subsidization, there are equilibria without cross-subsidization. Enough said, hopefully. Right. I'm again one slide ahead of myself. This slide is telling you that AAs borrow to build credit history. ABs borrow to free ride on AAs building credit history. All right? There's a cost associated. So cross-subsidization may look like a cost of credit history building. It kind of is ex post. Ex ante, it's not. There is an ex ante cost of credit history building, which is, in order to build credit history, I take out a first stage loan. I can't commit myself to not dilute it too much tomorrow. So what sometimes happens in this model is over borrowing, what I call excessive borrowing.
Since you asked to interrupt me,
please do.
Realistically, is information about borrowers in the first stage with default rates, right?
No,
Which you don't have.
No. This is, again, sorry, the question was, the information that's available to lenders is information about default. Let's go back to my first slide. That's the traditional view of credit history. It's there. When it comes to emerging borrowers, the history isn't long enough. What we're offering is a complement. In fact, I am purposefully shutting that entirely down. There is no chance to repay yet in the model. I'm giving you a complementary story about credit history. So I agree, I'm not questioning for a second that credit history is largely a history of repayment. But in the early stage, it's also a history of borrowing, of taking on loans. And that's, so I'm purposefully shutting down the repayment part and focusing on the borrowing part, on information aggregation. All right. All right, let me not spend too much time on this, because I'm down to 7. It's possible that since I can't stop myself from diluting too much in the second stage, this taken on loan in the first stage actually, I wish I could stop myself. I wish I could promise you purple guys that I'm only gonna top up to a medium-sized loan in the second stage, because that's what I should do. I can't, I don't have that commitment. I'm gonna overborrow. Of course, guess what? You're gonna price it in. I'm gonna get screwed. Because of that, sometimes in a very narrow set of parameter values, very narrow, in a narrow set of parameter values, AA borrowers don't want to build credit history, and they just in that space of in that portion of the parameter set, we just sit on our hands in the first period, in the first stage, and then all of the borrowings happens in the second stage without credit history building. Related to that, this is a very nerdy slide, and then we're going to get to work. This is for theorists in the room. For theorists in the room. Sorry, I'm kidding. Having ability to aggregate information, having this mechanism of credit history building, having credit rating agents, having credit reporting agencies could be welfare reducing. Because instead of sitting on our hands and not building credit histories, we're gonna build credit histories and overborrow. And AA's preferred equilibrium is not necessarily social planners' preferred equilibrium. So that's part one. The second, even nerdier point is increasing the quality of information may backfire. There's like this small region where increasing quality of information actually leads us to start building credit histories and destroys welfare. All right, that was the nerdy stuff. Now, I promised you testable implications that are not obvious ex ante. Let's talk about my purple people who I borrowed from in the first stage. I borrowed from you in the first stage. You know you're going to get diluted. Just there's no, in the model, there's no doubt, because there's second stage. If I borrowed in the first stage, I'm going to top up in the second stage. The question is, would you rather see me diluted a lot or diluted a little? Now, standard kind of conventional wisdom is the less the better. Because for any given type of borrower, the less I borrow, the more likely we are to be repaid. Except in my model, only the best me's are gonna get the largest top up. So there's the first thing is that was the dilution effect. For any given borrower, the larger the loan, the lower the probability of repayment. But there is a selection effect. Only the very best borrowers are gonna get the largest top up. In the model, quite literally, you purple borrowers who gave me a loan in the first stage, you would rather see a large top up, not a small top up. So we call it more dilution is better, or more dilution is, yeah, we call it more dilution is better. We can actually check that in the data. And I, frankly, when my co-author said, hey, let's run that regression, I'm like, oh, there's no way. That's just too good to be true. It's there. And it's there only for emerging borrowers. Now, in the model, you knew you were stage 1. You knew I was going to get diluted. In reality, you don't know that. So that's where things get really interesting. In reality, the fact that I take on a new loan is bad news. The fact that I open the new card, sorry, what am I, on the left-hand side is probability of delinquency. It's called probability of default. The fact that I took out a new loan, bad news. But the larger the new loan, the not so better the, that did not work. The larger the loan, the less the damage. And it's not there for established borrowers. So that's it. That was my shockingly, I seriously, I did not expect that to hold up in the data. Katya just told me I have a whole of 3 minutes. Very quickly, credit history is not equal to credit score. The worst borrowers, BBs, are safest because they're so bad, nobody gives them a loan. As a result, they don't have high probability of default. Credit score is the reflection of probability of default. So in this model is a very nice illustration that building credit history doesn't necessarily mean improving your credit score. You might lower your credit score, but that's because you might increase your probability of default. But what we call credit history building is improving lenders' perception of your underlying type. So in my model, people are really hungry. So the guys who end up with the largest loans are the best borrowers. They also will end up sometimes with the highest probability of default. So there's a kind of radical distinction between a credit score and a type score and building credit history. All right. So I don't need to summarize this anymore, I don't think. What we are offering is a complementary view of credit history as that of aggregating the actual borrowing behavior as opposed to just repayment behavior. And we think that for at very early stage of a credit life cycle, that's an important force. And it seems to be there in the data. All right. With 1 minute to spare.
Let's use this one moment for questions and yeah.
Well, I don't have the finished story, but I'll at least start the story. So you have like two types of borrowers in your model, bad ones and good ones. Three types.
Keep going.
So, but for the credit card company, there are, well, let's call it three types of borrowers. One type of borrower is a person who gets credit card. He or she wants to build this history, but they don't actually take payable loan. So for most of cards, there is like this 100 days you don't pay and stuff. So people take this loan, they repay it without any interest, and they just want to build history or whatever. They are also not interesting clients for banks. And the people who take loans and never pay them back, they are bad, of course, type. But this first type is also bad for bank. So the most interesting type for bank is a person who takes a loan, but then like for more than 100 days, but pays back with interest. So whenever person just gets first credit cards, it is not clear if this person will be first type or second or third. Maybe this... So now here I didn't finish the story.
How many minutes does he have?
Yeah, so maybe this like getting new card signals something about, so that helps banks to distinguish between the first and the second type, for example.
I love where you're going with this. We even have names for that, and turns out, so they're called revolvers and transactors. Transactors are people who just, so let's be clear. In the model, there's no distinction between a credit line and the balance. A loan is a loan. And yet in the data, I was looking at credit cards and I was using credit limits as opposed to balances. Which, by the way, means that, so in the model, you kind of, there's this cross-subsidization because I'm paying the interest. In reality, if I just took a credit card
it's not
and I didn't pay the interest, then I did cross-subsidizing. Absolutely. Now, let's get back to your question, because I think it's actually a very interesting one, even though not necessarily related directly to that. Transactors are people who just charge every month and repay their balance in full. They never pay interest. You call them uninteresting to a credit card company. Guess what? Credit card company makes a ton of money on the interchange fees. So they're actually also good customers. In fact, that's me. And that's why they keep increasing my credit limit to make sure I have enough credit limit to keep spending. So there are transactors who are good customers. There are revolvers and repayers who are good customers, and there are revolvers who don't repay, those are bad customers. So in a way, the model is that of revolvers. There's very little work done on kind of figuring out who is more profitable, revolvers or transactors, and there is no kind of revolver score.
Still, revolvers should be more profitable for bank than just transactions, because they're doing both transactions and also pay interest.
But they have something to default on if things go bad. So it gets a little tricky. also amongst, yeah, anyways. We'll take that offline, because I think I'm out of time, and I don't want to stand in the way of lunch.
Okay.
Thank you.
observatory, which has been very important for describing the war zone in Belarus in the Western Ukraine. Welcome to you. Thank you.
Thank you. Just to watch the timing as well. Right. Hello, can you hear me? Hello? So I'm Julia. And it's my actually second visit already being part of this international conference. I think I came back in 2010. It was perhaps the second BEROC conference. A very nice environment, and actually I'm pleased to be back. So I think in my presentation today, I'm going to continue the topic of access to credit, so credit access, but focusing specifically on these marginalized groups, as I call it. So it's more like small and medium-sized firms, which actually lack credit history and which are normally often are excluded from provision of loans by incumbent banks, or like so either banks engage in credit rationing, or they tend to compensate for various risks via, say, increasing the cost of credit for SMEs. So the paper that I'm presenting, it's a joint work with my colleagues. So we have 4 courses in this project, and it's result of actually our joint engagement in a research project, SOPUS research project, which was funded by National Science Center of Poland. I'll quickly go through the motivation behind the papers, then I'll provide some contextualization of our research within the literature, focusing on both theoretical arguments and then empirical evidence. Based on this, I'll flag up our hypothesis that we postulate, and I'll discuss then the research design. So it's pretty much an empirical paper. And finally, drawing some conclusion and policy-making implications. So, in this paper specifically, we explore to what extent then the recent developments in financial innovation, specifically happening in banks, help then ease financing constraints on this more excluded groups, as I call, and as customers, like small and medium-sized firms. So why do we focus on SMEs? It's just because they tend to form the backbone of the European Union economy. They account for more than 50% of the gross domestic product, but also employment. And the literature, vast already, emerging literature documents that actually SMEs are by far financially constrained compared to larger firms, and also this places in turn constraints on their growth opportunities. So that's pretty much our motivation. So why, I mean, theoretically, talking about financing gap between SMEs and larger firms, so it's largely attributed basically to inherent information opaqueness of SMEs, and they were primarily attributed to this lack of experience, lack of credit history, lack of reliable reputation, which all then raise risks for banks in terms of funding than SMEs. This is also further aggravated by weak financial performance normally of SMEs, with a high percent of them experiencing, say, failure during the first at least 3.5 up to 5 years of their operation, and also by the lack of collateral. So that's explained why generally we see then banks engaging either in credit rationing when it comes to funding SMEs via provision of that, or when or via, say, increasing, for example, the cost of intermediation for SMEs. So the recent actually developments or advancement in financial technology spanning across different sectors like credit service provisions and personal finance and then also welfare management. They all were largely kind of pioneered by fintechs, financial technology or big technology companies, and created actually new funding opportunities for more kind of marginalized or excluded customers, including like small and medium-sized businesses. So looking just at this graph, you can see how the proportion of non-bank financial institutions which are with a large actually share of this financial institution being represented by fintechs has increased substantially over the past decades. These are the green bar here, and in fact exactly like other financial institutions like fintechs, they tend to account for the largest share of non-bank financial institutions, and in specifically 2000 that was 30% as compared to, for example, if you talk about traditional banks, it's 38%. So they're becoming to play a more important role in funding, actually, as the real economy. Right, so the more specific sub-questions that we address in this study is whether bank financial technologies and helps increasing access to credit for SMEs, whether then it has any effect on debt maturity, to what extent then it helps reducing cost of credit, benefit more specifically younger or smaller firms, which are considered to be more informationally opaque, and whether then help reducing the need for collateral, and also we kind of place all this consideration of this relationship in the context of different credit market structures, say dominated by either traditional banks in the form of presence of branches, or where we have higher penetration, for example, of fintech companies already in credit markets. Right. In terms of theory, actually, financial technologies then argue to reduce information frictions, exactly via, say, greater information availability and data sharing, and also then, in this way, this high availability of information and sharing helps then improving credit risk evaluation of customers and specifically then benefiting more excluded customers or borrowers. Similarly, like machine learning models, the use of machine learning models and then also artificial intelligence algorithms, they help then for more precise assessment of credit applications of borrowers, but also helps them monitoring borrowers in real time, and all these actually then, I mean, in this case, great availability and use of information helps to substitute for collateral. So there is less needs than for collateral. And also, some scholars argue about that the application process with the adoption of financial technologies becomes faster, and then the lending, borrower-lenders relationship is then less dependent on the personal relationship. It's what we observed previously in the context of traditional banks actually serving their customers via, especially marginalized ones like SMEs, via developing more relationship lending. And some more actually evidence based on the US banks argues about that financial technology helps then increase operational efficiency of banks, and this should translate actually in the reduction of the cost of intermediation. But the studies are quite inconclusive in this respect. Specifically using this the sample of US banks, the scholars find that there is no significant effect actually on cost of intermediation from the side of financial technology. So while these kind of studies and literature provides more pros in terms of supporting the positive effect of financial technology on access to credit and also reduction for cost of intermediation for SMEs. We should bear in mind that there are various limitations or restrictions in place, specifically placed on banks in terms of using some alternative data when it comes to data sharing and using them specifically in the credit scoring models. It's more specifically the data which comes from social media, for example, and etc. So these may then affect banks in the sense that even if they increase lending, so they tend to go more for provision of loan, short loan rather than long-term loans to their customers. So they shorten then the credit maturities. They may also demand then for additional collateral or then increase the cost of credit to compensate for risks by when increasing the provision of loans to such customers. So based on this, we postulate our hypothesis, and we expect, first of all, that the impact of bank financial innovation would be in stimulating actually SMEs credit to debt. And we expect that this effect would be stronger actually on short-term credit provision as opposed to long-term when we speak about maturity. In terms of effect on the cost of funding, I think we rather take the views from the earlier studies done by US scholars, more specifically Philip Horn. He observes, for example, in the sample of US firms, banks, the increase in operational efficiency, but he argues that this does not translate actually into reduction in the cost of intermediation. But further, we argue that referring to some studies done on fintechs, more specifically the work from DiMaggio and his colleagues, that what observed in terms of fintechs is that there is increase in this engagement in moral hazard behavior from the side of borrowers, and this increases obviously the risk of funding such borrowers, and so they tend to compensate for this by increasing actually the cost of borrowing. So handsomely, we also postulate that financial innovation at banks is likely to increase the cost of debt. Now, we also zoom then the focus going from small and medium enterprises in general to zooming into actually startups or younger firms and also firms which are small in size, because we consider them the most informationally opaque. And since we argue about that financial innovation is to reduce and mitigate financial friction, so we think that the effect should be stronger actually on these younger and smaller firms. So consequently, we expect then them to benefit more in terms of access to credit if banks engage in financial innovation, but also in terms of getting access to more cheaper credit. All right, yeah. So further, we postulate hypotheses regarding to collateral, expecting actually that the need for collateral to be reduced with actually availability of bigger data, sharing of the data to kind of appearing to substitute then for collateral. And we consider also the effect of financial technology, as I said, conditional on credit market characteristics. So in terms of access to credit, we expect less pronounced effect, where still we observe higher presence, for example, of traditional banks in the form of branches, but the effect to be more pronounced where we observe higher density of fintechs in the credit market. And in terms of the cost, we actually argue about the inverse relationship. So we observe reduction in costs exactly in when the environments have higher traditional banking presence, whereas there is an increase in cost of intermediation where the fintech market is more developed. Now, why we have so many courses is just because we have so many data sets to deal with by trying to answer these research questions. So we start with using actually Amadeus Bureau Van Dyck data, which is financial accounting data on firms, and we specifically use a sample of small and medium-sized firms here, spanning across European Union over the period of time from 2008 to 2019. We then match, so basically Amadeus data gives information, not only financial information on firms, but also the affiliation actually with banks as well. So it's how we get information on which individual firm is affiliated with which particular bank. The issue is that, unfortunately, firms report more than one affiliation, and here you can see actually while 70% of our sample, just above 70%, report just affiliation with one bank, actually about still 20% who report affiliation with two banks. That creates slight problem, but then we use various robustness checks in terms of trying to actually attenuate the effect of this affiliation with multiple banks. Now, we use a set source of data in order to collect information on financial innovations. And here we specifically use Crunchbase, CB Insights, also bank financial statements and public announcements, and use web mining to actually collect the data on various solutions, digital solutions, which were introduced then by banks over time, including like automation software, the use of automation software, blockchain technology, data analytics, lending solutions, payments, personal finance, regulatory technology, and also we sum up all these aforementioned solutions just to get an overall indicator of financial innovation intensiveness of banks. The model is actually, we use a number of dependent variables to answer our research questions, and we focus on the overall debt growth rate of debt of SMEs. We focus separately on short and long debt rate growth rates, and also we look at the ratio of short-term vis-a-vis long-term debt in order to gauge about the effect of financial innovation on the maturity. We employ as a baseline model, we employ panel fixed effects model, controlling for firm fixed effects, but also year fixed effects, and we introduce additionally like sectoral fixed effects in case if firms tend to migrate across sectors over time. It's not many of them, but it still happens in the data. So we also then control for firm level characteristics. There are quite a number of them, and these are listed here. I can expand more on this once if you are interested. So we leg them by one, two, once again also to attenuate the issue of indigeneity, of at least of these firm level characteristics in affecting our potential dependent variables. And we also control for main bank with which a firm is affiliated characteristics, including its size, loans, and the ratios of equity as well as deposit growth. And we add also country-level controls on the one hand side to capture then the credit market characteristics like fintech credit per capita provision, and we use also branches, number of commercial bank branches per 100,000 adults in order to capture then the presence of traditional banks in the credit market. Apart from this, we control also for business cycles via GDP growth and employment rate and the initial level of economic development via GDP per capita. Now, I skip actually providing all the results here. I mean, in the sense of a full length table, as it's quite lengthy. I mean, it's over 2 pages each table. So I just report the main results in terms of the effect of bank financial innovation. But if you are interested, the paper is available as a working paper, so you can follow this up and read in more detail. Right, so what we observe in terms of our hypothesis one, so in terms of credit growth, so we observe actually that bank financial innovation, if you look at all these different types of financial innovations, individually benefit increase of SMEs access to credit, and this effect is stronger actually on a short term credit growth as compared to long term. So in terms of maturity, what we observe is that banks tend to switch more from kind of relationship lending, where they could also provide like long-term credit, to more sort of increasing the provision of short-term credit, but in this sense they tend to compensate for actually increased risk of potential borrowers. Now, we don't actually, looking at the base model, we don't find any significant effect of actually cost of intermediation on the effect of bank innovation and financial on cost of the intermediation which SMEs encounter. But only we find the significant result in the case of the use by banks of business analytics. If they employ this innovation solution, this tends to then increase the cost of intermediation by SMEs, for SMEs. And the reason for this, as we think, so basically then banks get some alternative data which may not necessarily be to advantage of SMEs when assessing basically their creditworthiness. Now, then we actually look at the effect of financial innovations on smaller firms and also younger firms, and what we find is that financial innovation does not necessarily actually help then these opaque firms to eliminate financial frictions, at least in part of actually access to credit. But we find actually the significant effects then of financial innovation solutions across quite a number of them on actually reducing the cost of intermediation for younger firms, which are startups that could be potentially these high growth firms. Now, speaking about collateral, also there are some consistent results on that. We observe the reduced need for collateral when SMEs tend to obtain their credit, and by the way how we measure this is just we take the share of fixed assets as a proportion of total assets for firms, and then we look exactly at low collateral denote exactly as firms which have less than median share of this fixed asset as a proportion of total assets. And finally, speaking about credit market structure, so what we do find in terms of the access of credit, so the upper panel reports the results actually for the high presence of traditional banks, and then the lower panel is in terms of high presence of fintechs. So we observe that where there is a high presence of traditional banks, there is less actually scope for financial innovation to further increase, for example, access to credit. But we find some complementarity between actually financial innovation introduced by banks and then presence of fintechs in increasing actually access to credit by SMEs. Thinking about actually Igor's presentation just in this context, so either banks appear to be kind of free riders in this case, free riding exactly on the information that fintechs collect via alternative data, using alternative data sources. And actually, interesting thing that banks, there are various restrictions imposed on banks in terms of using some of this alternative information, especially coming from social media, in their credit evaluation models, whereas such restrictions are not in place on fintechs. that's why I'm thinking about more this free riding aspect of this complementarity issue. The other thing could be that still in the markets where we observe higher presence of fintechs, I think I've seen recent survey from EBRD, European Bank for Reconstruction and Development, which shows that banks still do not, in carbon banks, they do not still see a threat from fintechs in the serving, for example, corporate clients or small and medium-sized firms in terms of provision of credit. So the threat occurs more in like provision of personal finance solutions, so basically serving individual customers or, well, that's pretty much it. Finally, in terms of the cost of intermediation, so the pattern is pretty much reversed. So what we observe that in countries with more developed banking sector, financial technology helps reducing the cost of intermediation for SMEs, but it tends to increase it in countries with higher presence of fintechs. And here we think exactly in the context of these demerger studies that the risk actually for lenders is increased with focusing on these marginalized borrowers. So that's why even for fintechs, we have already valuable evidence showing that the cost of intermediation increases, whereas we don't see this for banks. But banks, so first of all, as they follow the step of fintechs, they don't undercut the cost, and they provide it still at this level, or effective rate, borrowing rate would be even higher. And in this case, banks also tend then to compensate for potential higher risk which emerges in serving basically these marginalized SMEs. Now, robustness check. So we check for the indigeneity of, say, potential, say, bidirectional causality between our financial innovation indicators and then all dependent variables. And we use then generalized methods of moment, system generalized methods of moment here in order to address this. We use also as I said, we reduce the samples then just to only focusing on firms which declare actually only one main bank as a provider of financial services, and then we switch, like we move from maturity, focus separately on short-term and long-term debt growth rates. And finally, we employ also some alternative measures of bank innovation from global data-based innovation scoreboard. And it's exactly a number of file patterns which captures basically kind of the input measure of innovation, then a number of granted patterns which measures actually the output measure of innovation on the side of banks, and then we control for a number of deals bank has involved as a venture capitalist. Mostly it's investing in fintechs actually. One problem with this actually data is that it's by far reduced in terms of observations. So we lose half of the samples. That's why we use it more as a robustness check rather than as a main set of our results. So what we find actually in terms of all these robustness checks, the first one on the generality, actually, the results are reconfirmed, but what we get is finally we get the significance of our effect of financial innovation on the cost of intermediation. So this is panel B here. So you can see that once we address indigeneity, so the relationship is becoming positive, and we observe then that bank financial innovation tends to increase the cost of intermediation for SMEs. Finally, as I said, when we use alternative robustness checks, as this is just using fixed effects model, so reconfirms the results on the access to credit, so the effect is positive, and we even use this reduced sample, but alternative measures of innovation. But the results on on the cost of intermediation remain just insignificant. But here we don't yet use our GMM model in order to test the robustness of these results. Now, so in terms of summary, so what we find in this paper is that bank digitalization overall tends then to increase actually SMEs credit to access, but primarily actually benefiting then short term vis-a-vis long term when we speak about the maturity of credit. It also, if we actually talk about the robust results that we obtained by using system GMM. So we find that there is an increase in the borrowing for SMEs, but younger firms that benefit from lower borrowing rates at more digitalized banks. So this is also an interesting just finding on its own concerning these more opaque firms. And also, we find that collateral becomes less important at financially innovative banks. Finally, we find some conditional effect of credit market structure, where says there is some complementarity in fintech presence and banks affecting the access to credit, but increasing actually the cost of intermediation. So in terms of policy recommendations, since our sample is based on the EU firms, so interestingly enough, the measures, I mean, you know that the EU has invested now quite recently a lot in enhancing financial digitalization of the whole region, and a lot of Horizon 2020 or Europe grants, they exactly focus on this agenda. And so far the measures that's been taken, in fact, they been quite effective in terms of then helping SMEs to get access to credit, but unfortunately, these measures are not yet sufficient in order to impact actually the cost of these financial services. So this does not fully resolve the issue of financial exclusion. And also what we argue is that it's important when the policy measures are drafted, it's important actually to take into consideration then the credit market structure, as all this relationship are conditional on the credit market structure. Just a few last words. It's we continue working with this data and extend then the focus also to SMEs performance, because it's interesting to see not only how the lending patterns change, for example, with prevalence more of short-term debt vis-a-vis long-term in terms of SMEs loan portfolios. And we simultaneously look at the effects then of all these channels on sales growth, or turnover growth, and employment growth. And we are getting some interesting results actually about the negative effect exactly of this shortening of debt on sales of SMEs. Also actually the effect tends to manifest negatively on sales, while the increased cost of intermediation for banks. Sorry, for SMEs. So this is still work in progress, and so thank you. Your feedback would be more than welcome.
I haven't seen Italy in the list of the countries. Just
Italy. I don't remember actually if we had. I think we definitely have Spain, but let me see.
Was there a reason for that?
Yeah, I think some of the countries we couldn't include because of quite a lot of missing information, either on the side of SMEs, for example, for lending provision, more specifically for this lending patterns that we wanted to capture, or on the side of banks in terms of provision of financial innovation data. So it's just purely to do with data limitation. Though I remember you actually commented about the good quality of Italian statistics. Yeah. Yes, but I mean, we also capture, for example, Spain, which is, I think, the largest country in the EU dominated by SMEs. Yes, sorry.
Nothing to be sorry for. Could you help me think through the extensive margin? So the way, especially your results about, innovation leading to lower sales. To me, and the same thing with the cost of credit. To me, it sounds a little bit like if bank invests into that innovation, they're better able to discriminate the truly marginal, but still profitable from the market. Basically, groups of SMEs they wouldn't have touched before. Now they understand that some of those really risky guys are actually worth dealing with. It's going to be reflected in smaller sales and higher interest rates.
Yeah, so what we observe exactly is not the case for the sample of SMEs overall. We observe actually the increase in the cost of intermediation for the whole sample of SMEs, but we observe the reduction in the cost of credit for younger firms. Not smaller, but younger. So you see maybe younger gazelle firms or like unicorns, which they tend to focus on. Yes, please.
Any more questions? Okay, then last question from me. The technology takeoff should be endogenous in a sense, right? And I mean, are you able to somehow differentiate banks which were, I understand that you're doing it from the side of the firms, but still, which were more like focused on SMEs and what type of technologies they were more likely to introduce and whether it might affect your results?
Thank you, Katerina. It's a good question. I mean, we actually do robustness checks in terms of the potential indigeneity between the two, but it's more in the sense of reverse causality. Unobserved heterogeneity is addressed at the level of firms, but it's already then absorbed in itself and heterogeneity at the level of banks because it's lower level of aggregation. So it's more via technical way we sort of deal with this problem, but I don't think we can use any selection type of models because, as I said, we focus on SMEs rather than banks in this case.
Thank you. So no more questions. Let's give a round of applause. Thanks. And our next speaker is Aliaksandr Amialchuk, also our long-term friend and probably the candidate for the catchiest title in today's conference.
Sorry. I think it's somewhere here. Let me see. Yeah, it should be here. This is yours? No? Yeah, like that. And sorry, for full screen, you need also to use this option, duplicate slideshow.
Thanks. Hello, everyone. My name is Amialchuk. I'm originally from Hrodno, Belarus, and I've been working at the University of Toledo for the last 15 years. Toledo in Ohio, in the United States, and I've done this paper with a former colleague of mine who now works at Substance Abuse and Mental Health Center for the federal government. And my research interest is in risky health behaviors of adolescents. I've been researching all kinds of risky behaviors, drug use, through the past 10 years. So this is right up my alley. And so I'm going to talk about the long-term health effects of initiation of marijuana use in adolescence. And so I'm going to give you a little bit of a background on the marijuana use in the United States. I'm going to talk, this is empirical paper, so I'm going to talk about identification. I'm going to use instrumental variable strategy to arrive at the causality, and I'm going to talk about some of the social psychology that underlies the instruments that I use. Then I'm going to present the results and some interesting robustness checks. So I'm going to present some of the things that you might consider doing in your own research if you're thinking about using instrumental variable strategy. So I'm going to talk about marijuana in the United States. So far, last time I checked, we had 39 states, including Washington, D.C., that have legalized medical marijuana use. And then we have 21 states and Washington, D.C. that have legalized recreational marijuana use for adults, 21 over. Ohio is unfortunately not one of those states, so we Ohioans have to travel up to Michigan to get some pot, and it would be nice to have Ohio among those states, strictly for research purposes. But it's coming. So there has been a wave of marijuana legalizations starting for recreational use starting around 2012, and in the roughly past decade, marijuana use among adults has doubled, almost doubled. So people are really using marijuana these days, and adolescent marijuana use, while it's illegal, it's still I don't know how to call it, a big problem, or we are making progress, but it's quite high and it's increasing. So one source suggests that adolescent marijuana use among those who have ever used marijuana increased from 30% in 2016 to 32% in 2018. And if you look, another source suggests among 12th graders in 2016, 22% use marijuana in the past 30 days. That's a lot of kids using marijuana. And 36% of 12th graders back in 2016 have ever tried marijuana. Those are some big numbers. A lot of adolescents report easy access to marijuana, and there is a widespread perception among young people that marijuana use involves minimal harm. When it comes to health effects of marijuana use, well, it's a common perception that marijuana use has some pleasurable effects, which include relaxation, improved mood, increased appetite. I'm not going to ask questions if you guys can relate to those experiences or not, because I realize marijuana use in Lithuania is illegal. But so there is research on the health effects, and there is mostly associational, correlational type of research, and literature finds that regular use of marijuana is associated with depression, anxiety, panic disorder, cognitive and memory deficiencies, problems with perceptions of time and space. Sometimes those problems start right away, and then they go away as you use it more and more. And many of those associations disappear once you start controlling for environmental confounders. So that's where we come in with our econometric tools to ascertain is there a causal effect of marijuana use on health. We do know that most marijuana use is initiated at young age, probably in high school. There is so peer influence is probably the major driver. You learn how to use marijuana, you get it from your friends, from your schoolmates. And when it comes to peer influence, it's both observing your friends or siblings use marijuana, as well as perceptions about marijuana use among your peers, and those perceptions might sometimes be biased. So what we do in this paper is we use a large nationally representative data of United States adolescents, which started back in 1994. The data set is very popular. It's called National Longitudinal Study of Adolescent to Adult Health, or abbreviated as AdHealth. So if you're a health researcher, you're most likely familiar with this data set. So it started in 1994, and it continues. So it's a panel survey. It has several waves, and it has a lot of information on health behaviors. And we focus, well, currently the people in this survey are about the same age as I am, and probably most people in this room. I kind of makes it personal to me to look at the what might have happened if I started using marijuana a long time ago, and then my son is here, so what should the message be to the younger generation? So what I do is, well, we do with my colleague is we look at the effect of initiation of marijuana use at ages 12 to 19, and how that affects some of the mental health indicators roughly 20 years later, when those same people are between the ages of 31 and 42. And in order to arrive at the causal effect, we instrument the adolescent marijuana use with two instruments. One is perception of the adolescent about marijuana use among their friends, and the second is actual use of marijuana by peers. And the outcomes, the health outcomes which we look at, which are measured in the fifth wave of data, which was collected between 2016 and 2018. So one is depression, indicator for whether the person has ever been diagnosed with depression disorder. Is based on the question, has a doctor, a nurse, or other healthcare provider ever told you that you have or had depression? Then indicator for anxiety disorder, based on the same kind of question. If you had been diagnosed with anxiety or panic disorder. And the third outcome, suicidal thoughts or attempts. If you experienced any suicidal thoughts in the past 12 months, or attempted suicide in the past 12 months. And our main explanatory variable is whether you used marijuana in 1996. It's a binary variable. So whether you used marijuana at least once in the past month or not. And we include a lot of individual level controls, so basic socio-demographic controls like age, gender, race, ethnicity, and family level controls like whether parents have a college degree, whether you have older siblings. Then we include school fixed effects and some other variables, and those controls are important because the way instrumental variable strategy works is that conditional on observable variables which you're able to control for, there is a conditional independence assumption. Instruments are as good as randomly assigned, conditional on those controls. So we use two instruments. The first instrument is the number of best friends whom the respondent perceives to be users of marijuana. It's based on the question asked from the responder: of your 3 best friends, how many use marijuana at least once a month? So regular users among your 3 best friends. And then the second instrument is the proportion of friends who use marijuana. And this proportion of friends is based on questions asked directly to the friends of the respondents. So the data set is famous for being probably the only data set in the United States where students are asked to nominate their school friends, and then within the same school, the survey finds those people, because all people in the school ask the same questions, and you're able to connect the respondent to their friends, and then you can connect those friends to their friends. And we don't want to rely on the friends as the peer group, because that's endogenous, because there is a lot of selection. People select their friends based on preferences and other things. But friends of friends is more disconnected from you. So if your friends of friends are using them, your friends are more likely to use it. And those friends of friends, our restriction is that they're not your direct friends. So you didn't nominate those people directly. It's your friends of friends. So that helps in identification. And so the assumption behind our identification strategy is that after accounting for all the socio-demographic and other controls, observable characteristics, the only way that our instruments, the only way that the number of best friends that respondent perceives to be users, or proportion of friends affect the outcomes, the health outcomes, is through respondents' own use. So that's the exclusion restriction of the instruments.
Sorry, can I ask one quick question? How do you define friends of friends? Is it based on 3 best friends, or there is another statistics where they list all their friends?
Are you talking about the first?
No, who are friends of friends?
Oh, friends of friends. Okay, so those are each person in the survey can nominate friends up to.
All friends, not only 3 best, all friends.
Right. Yeah. So yeah. So those are different questions. Yeah. Yeah. Those instruments are constructed differently. The two instruments are actually related. We rely on literature in social psychology, and one of the famous papers describes sociological model of peer influence on your behavior. So actual peer norm, which would be average use of marijuana among peers, has an effect on your personal use of marijuana, and then perception, your perception about the use of your peers also has a direct effect on your personal use of marijuana. But actual use of your peers might affect your perception. So both instruments have direct effect, but there is also correlation between the instruments. And this is part of the reason why in the main analysis we are using perception as the only instrument. And in a supplemental analysis we include both instruments, because those two instruments are kind of measuring the same thing. I guess the major difference between perception and actual norm, actual use of friends, is the misperception, because people often misperceive how much their friends are using. And the mechanism of relationship between the instruments, the peer use or perception about peer use, and own behavior, own use of marijuana or other drugs, is described, is I guess best described in the famous study by Charles Mansky, the economic analysis of social interactions, where he explains that when you look at the correlation between peer use and my personal use of drugs or any other behavior for that matter, there are three things in that correlation. One thing is the endogenous effect, which is the peer effect. The second is called exogenous or contextual effect, and the third thing is correlated effects. So what are those three things? Endogenous, exogenous, and correlated effects. Well, endogenous effect or endogenous peer effect is the behavioral peer effect, behavioral influence of your friends on you, on your behavior. And for example, if my friends increase their marijuana use or start using marijuana, I will increase my marijuana use or start using marijuana. And we use friends of friends, so there is not much selection in that. And perceptions, we think, are mostly driven by misperception. And so we rely on endogenous peer effect as a source of exogenous variation in the IV. Then the second type of effect is called exogenous or contextual effects, and it's the response of individual behavior to exogenous characteristics of the peer group. For example, older siblings might affect younger siblings' marijuana use just because older siblings' marijuana use increases with age. The older you become, the more likely you're to use. Or if there are parental rules at my friend's home that prohibit drug use, then those parental rules will translate to lower use by the respondent through lower use by his friends. That's another example. Those effects, exogenous effects, are also used as exogenous variation RIV. And the most troublesome effect is called correlated effects. So those are all kinds of selection issues. When people select friends, they select based on maybe common use of marijuana, or maybe based on commonalities of their socioeconomic status, maybe they're from disadvantaged backgrounds. Or when peers face the same environment, like they go to a school in bad neighborhood, and that bad neighborhood is famous for higher drug use. Or anything else which is shared by the two people who are friends. So those things make our instruments endogenous, because my future health depends on the environment that I grew up in. And that same environment made my friends use marijuana too. So, and marijuana used by my friends is an instrument, so that makes instrument endogenous. And we try to control for this source of endogeneity in the instruments by including a lot of individual level controls and school level fixed effects. Now, the difference between the instruments, the major difference, is probably the perceptual bias in the norm. The perceptual bias about the norm. And there is a paper which is an essentially economics paper, but it relies on insights from psychology, which describes how perceptual bias, which is psychological construct, translates into aggregate behavior and changes in aggregate behavior within a cost-benefit framework. And in this cost-benefit framework, conformity to social norms implies that consumption of drugs will adjust in the direction in which you have a bias. So if you think your friends are using marijuana much more than they actually do, then you're gonna start using marijuana more. Not because your friends are using it a lot, but just because you think your friends are using a lot. So this is the basic cost-benefit framework of how things are in the market for breaking a norm or breaking a law. So demand for, so this is demand and supply for wrongdoing, for breaking a norm, in this case smoking marijuana, which is illegal in adolescence. On the x-axis we have proportion of people breaking the norm, and marginal benefit of breaking the norm is downward sloping, because if we rank people by amount of benefit that they receive, starting with the high benefit people from breaking the norm to lowest benefit people, we're gonna get this downward sloping demand curve. And supply, it's not upward sloping, because most of the time when it comes to wrongdoing, the more people that have already have broken the norm, the more people that are using drug in this case, the less likely you are to get caught and experience a cost of being caught doing this wrongdoing. And so that kind of safety in numbers implies that the supply of wrongdoing, marginal cost of wrongdoing, is downward sloping. And if we hypothesize a curve like this, then you're going to have at least two equilibriums. Here and here, where this would be a stable equilibrium, so the proportion of people breaking norm will converge to this point, or unstable equilibrium, where on this part the cost is higher than the benefit, on this part the benefit is larger than the cost. So if something happens to the system, the proportion of wrongdoers, breakers of the norm, will deviate away from this equilibrium, and number of people breaking the norm will either be zero or it'll converge to the stable equilibrium. So that's the basic cost-benefit framework. And then if you introduce the bias, perceptual bias, into this framework, bias is when you think more people are engaged in this behavior than actual. So if we start with the actual equilibrium, so this would be the actual marginal cost, the true marginal cost of breaking the norm, and this is the marginal benefit. So the stable equilibrium would be this proportion of people breaking the norm. But if I think that proportion of people breaking the norm is higher, then within this framework, it means I'm underestimating the marginal cost of breaking the norm. And then what happens is, little by little, people will adjust their behavior until the aggregate proportion of wrongdoers becomes higher. So if a lot of people are misperceiving the norm, they're gonna gravitate towards that misperceived proportion of people breaking the norm. And the same thing can happen in the reverse. If people underestimate the number of people engaged in this behavior, then the aggregate proportion of wrongdoers will gravitate towards the lower equilibrium. But in case of drugs and addictive substances, by and large, and I've been engaged in this research for at least the past 10 years, people tend to overestimate how many other people in their peer group, for example, are engaged in substance use. And this is, the overestimation is especially pronounced for illegal substances. So if you look at smoking, drinking, and marijuana use, the overestimation of people engaged in this behavior is largest for marijuana use, because this is the most illegal drug among the smoking, drinking, and marijuana use. So marijuana use of peers is gravely misperceived by people and is greatly overestimated. And this is true in the data. Now, what is the source of misperception? Like in our case, we would be interested, is the source of misperception endogenous to the future outcomes or not? That would be a make or break fact for using our instruments to arrive at the causality. The literature on the causes of misperception is almost non-existent and sporadic, and it's mostly hypothesis of what might be driving misperception, but there are several papers that argue that normative misperceptions are induced by largely observing a few people engaging in extreme and unusual behaviors. Like if you see a lot of some freshmen or seniors in college drunk after the frat party, you think everybody is drinking. But that doesn't reflect the actual norm. The actual norm is usually pretty mild amount of drinking. Now, that's probably the major source when it comes to adolescents, just observing a couple of their friends or schoolmates engaged in these unusual behaviors. But media plays a big role too. Media usually fishes for eyes, and you cannot get a lot of views if you advertise normal behavior, because that doesn't make a sensation out of your story. What makes a sensation in your media story is some extreme behaviors, articles about some drunk drivers who are adolescents, or adolescents being caught smoking pot in a parking lot, stuff like that. And then this media coverages are amplified further by rumors. So that's how we think the bias is born, and we think it's a source which is exogenous to future health outcomes, which we're going to study in this paper. So when we look at our data in the last survey that we used to measure outcomes, we have 12,000 observations, 12,000 people. Back in 1996, so we observe our sample in 2016, 2018, when we measure the health outcomes. When they were young, 20 years earlier, about 15.6% of them are marijuana users. So we are talking about middle and high school adolescents. And then 20 years forward, the marijuana use is a little bit lower. These are the same people. But again, some of these people might have discontinued using marijuana, some of them might have picked it up during this 20 years. So we don't know that. Then 7% are regular marijuana users, which is approximately every week you use marijuana. Then out of 3 best friends, people report 0.7 friends are using marijuana. Among friends of friends, 15%, approximately 15% of marijuana users, which is consistent with the data reported directly by the respondents. And then in 2016, 19% have ever been diagnosed with depression, 20% diagnosed with anxiety, and usually depression and anxiety go hand in hand. They kind of reside in the same part of the brain. and then about 7% have experienced suicidal thoughts or attempted suicide in the past 12 months. So those are our 3 outcomes: anxiety, depression, and suicidal ideation. So we estimate instrumental variable model using 2-stage least squares. If we run the first stage, which suggests whether our instruments are strong or not, we find that when we restrict our analysis to using only one instrument, perceived number of friend users, as reported by the respondent. So one additional friend using marijuana translates into 20% more higher probability of you using marijuana. So all of this is happening during adolescence in 1996. So we get pretty strong instrument, which is nice. And when we look at the main effect, the instrumental variable estimates of the effect of marijuana use in adolescence on your future health outcomes 20 years later, so here we compare OLS coefficients to 2-stage least squares coefficients side by side, just to see if how much endogeneity there is, which biases our coefficients. We see that so OLS shows only anxiety is affected by your marijuana use in adolescence. Suicidal or depression are not affected. And then 2SLS shows that there is some action as far as suicidal ideation goes, but anxiety is really where the effect is. So if you use marijuana versus if you don't use marijuana as an adolescent, this causes you to end up with anxiety 20 years later after we use the instruments. So this is the estimate of the causal effect. And this effect is about twice the magnitude of OLS. So I have about 5 minutes. Right. So we do a series of sensitivity tests and subsample analysis. So briefly, what we do is we divide our sample by gender. We discover that only females have increase in anxiety if they smoke, if they use pot as an adolescent, that not males. We test our instruments. We do placebo regressions where we estimate 2-stage least squares models for outcomes which are unlikely to be affected by marijuana use in adolescence, such as height, parental socioeconomic status, health conditions that adolescents experience before they could have started using marijuana. Then we also gradually include our covariates to see how much unobserved heterogeneity could potentially bias our 2-stage least squares estimates. Then we include both instruments at the same time, the perceived number of friends as well as number of friends of friends who are actual users of marijuana. Even though those are highly correlated instruments, there is still some independent effect of each instrument on the outcomes, which allows us to include both of them without much concern about multicollinearity. And the reason why we include both instruments is mostly to test for exogeneity of instruments using over-identification restriction tests, and we pass over-identification restriction tests. Then we test the plausible violation of the exclusion restriction by allowing for the possibility that instruments might have a direct effect on the outcomes in the second stage model. What we do is we estimate the confidence bounds on the IV estimates using the method proposed by Conley in 2012, plausibly exogenous. This can be done using state command +exog. And the way we initiate our parameter for the direct effect of the instruments on outcomes in the second stage is by relying on the so-called zero first stage regressions, where you select a subsample from the main sample where you see that the instruments have no effect in the first stage, so the instruments are not valid. And then if we discover there is a effect in that subsample in the second stage, we use that the estimate of the direct effect of the instruments to estimate the bounds. So that's how it's done. Then we also change our definition of marijuana use in adolescence. We look at regular users, which we define as using marijuana at least 4 times in the past month, which is roughly the definition of CDC for regular using, which is once a week. And we get stronger effects, which is another indication of causality, because epidemiology, which has different definitions of causality and different methods to arrive at causality, suggests that if you have a dose response kind of effect, if you increase the dose and the response becomes larger, that's one of the indications of causality. And then we also implement an IV, instrumental variable estimation, which is now 2-stage least squares, to test the linearity assumption of 2-stage least squares. We actually implement full matching estimation, where if you guys are familiar with the matching, like propensity score matching, what you do is you select 2 comparable sets of people, comparable based on pre-treatment variables like socioeconomic status back in the 1994. You select 2 comparable groups of people where the only difference is the instrument, the value of the instrument, whether you perceive or not perceive your friends to be users, for example. And then you compare the values of the outcomes between those 2 subsets of comparable people. And there is a statistic that you can compute which is comparable to 2-stage least square statistic. So all of this sensitivity analysis support our main findings. If you're an adolescent, you use marijuana, you're gonna end up with anxiety, and that's only specific for females. Thank you. Do we have time for questions?
Yeah, we have, I think, still a couple of minutes for questions. So, yeah.
Wait.
Could you please go up to the very beginning of the slide when you describe the age of the groups studied? This one. So I'm sorry, I maybe really messed up something here. Did you control for the possible fact that adolescents had some mental health problems before using marijuana? So they are using it because?
Right. We specifically excluded those from the sample.
Why?
Adolescents who reported, so we have a measure when you were diagnosed with anxiety and depression. We exclude adolescents who were diagnosed with those before we started measuring the marijuana use, so that we don't end up with the same anxious adolescents 20 years later.
But they might be held up when they get adult.
Right, that's a good point. So they might still give us
some
juice in the estimation.
When they are adolescents, and then do not report anxiety when they are adult, although they use marijuana.
That's a great point. Yeah, we should include them. Then our effect disappears, and we won't be able to publish. Thank you so much.
Strange question, but in general, how many people in their 30s and 40s are depressed? So there are 20% of those who are like using marijuana, and in general.
Let me see if I have that.
Maybe I also missed it. But.
So, I'm sorry, can you repeat the question?
So, marijuana users, there are 20% of them in their 40s and 30s are feeling depressed. No? No?
Among marijuana users,
Yeah.
how many are depressed? We did not look at that. But overall, in the sample, 20% are depressed in their 30s and 40s.
Okay.
But I can't remember when the last time I saw a pothead who is depressed. There's some anxious ones.
Like, I actually should go and read the paper, but just quick question. Why only 3, let's say, mental health issues were included? It's something from CDC?
That's pretty much all we had. And there were some other measures related to mental health. And those are not common.
Okay.
Mental health conditions, and they're really low percentages, so we didn't even want to look at those because we get into small samples and power issues.
Got it, thank you.
Thank you.
And our next speaker is Kristina Manysheva, who we are also happy to claim as one of our former students. Welcome, Kristina. Thank you for coming.
So the presentation is supposed to be somewhere here, no?
It will be, no.
Does this work? Sorry. Yes. Okay, perfect. Nothing is shown here, but let me start maybe. First of all, thank you so much for all organizers to put me into the program. And thanks everyone who remained. It's very last presentation and very long day. And finally, I assume that I have 5 more minutes compared to the schedule, right? Perfect. So as previous speakers, I suggest to ask questions on the way we go. I think this is going to be easier. And the paper I'm going to present today, I think very nicely fit with some of the research that's already been presented, like Igor's research on building credit history and Julia's research on SME and FinTech. So here's I'm going to do it in slightly different context. I'm going to talk about the context where credit history pretty much doesn't exist. And also FinTech is not at the level where small and medium-sized enterprises are not required collateral. So I'm going to talk about financial frictions and land property rights in the context of low-income countries. So as already was mentioned, those countries or level of financial development in those countries is extremely low. But on top of this, they also have insecurity in land property rights. So where exactly this insecurity is coming from? The first reason, it is lack of land formalization. So when you look at the map on this slide, you see the share of land in different countries in the world that doesn't have any documentation. And if we zoom in into the African continent, we observe that most of the countries are colored in red and orange, meaning that a large share of land in those countries doesn't have any title or any other formal document, or even informal documentation. Secondly, the kind of insecurity in land property rights is coming from presence of so-called communal land. So what is communal land? Communal land, such lands, it doesn't have any formal property rights, but it is governed by norms and customs within the communities. And one of the major principles among those norms is use it or lose it principle, meaning that whoever uses the land in the current period of time can continue using this in the future. However, if in a given period of time, the farmer or the household decides not to operate the land, this land can be taken away from them and reallocated to somebody else in the community. So, as a result of both lack of land formalization and presence of such communal land, we observed that in low-income countries, land first could not be sold or rented out. Second, it's subject to expropriation risk. And finally, this land cannot be used as collateral. So why am I emphasizing this last thing, that land cannot be used as collateral? Because when we think about households in those countries, they almost do not have any financial wealth. But majority of them, because of this communal land, they do have some land holdings. Therefore, giving them titles or improving formalization of the land might also bring them to the financial sector or improve their financial inclusion. More formally, what I'm doing in this paper, I'm looking at the effect of land and financial market frictions on the aggregate productivity and allocation of resources in low-income country context. And importantly, I'm also looking at the interaction between those two markets. And the way I'm doing this, I incorporate both land and financial market frictions into heterogeneous agent macro model, and then use this model to study what would be the effect of land reform. So how this would affect economy and resource allocation, and also I'm looking at different channels of this reform, including these collateral channels that represents interaction between land and financial markets. And I'm doing this in the setting of low-income country, as I mentioned, and specifically I'm using very detailed micro-level data from Tanzania to do some empirical exercises and also estimate parameters of the model. Given that I'm only having like 40 minutes, let me give preview of the results in case I'm not going to reach the last slide. So what I'm doing in this paper, on the empirical side, I'm not only using data to calibrate my model, but I also use this data to show that there is misallocation of resources in agriculture in Tanzania. And importantly, I'm able to link this misallocation to two sources. First, insecurity in land property rights, and second, limited access to credit. Then I use my model to study the effect of land reform. And here, importantly, when I say land reform, I'm meaning such reform that allows household to obtain the title for their land. So there's going to be no redistribution involved. Just we're moving from the economy with weak property right regime to the economy with strong property right regime. So what I find is a result of this reform, that first it leads to quite substantial increase of agricultural output by more than 7%. And this increase is primarily driven by better allocation of land across farmers. So in other words, as a result of this reform, land moves from farmers that are not very efficient in agriculture to those who are efficient in this sector. Secondly, and probably more surprising, I find that land reform also leads to increase by even higher magnitude in non-agricultural output. And such increase is primarily driven by better allocation of households across occupations. So as a result of this reform, households are moving from sectors where they're not productive to the one where they're more productive. And as a result of this shift, the share of farmers in the economy decreases by more than 8%. Finally, when I looked at the impact of collateral channels that represents the interaction between two markets, I find that it's qualitatively, in terms of its effect on different sectors, is very similar to the impact of financial reform. But it has very different distributional consequences. But this I'm going to talk a little bit later. And just to summarize the main findings, I find that land market frictions amplify financial market imperfections, and this effect is particularly strong for the poorest part of population who doesn't have much of financial wealth but does have some land. So the plan for today's talk, I'm going to start with a model framework. Then I'm going to briefly talk about the data that I'm using and what kind of exercises I'm doing to show that there is misallocation actually in the data. And in part 3, which I think probably the most important part, I'm going to describe the model mechanism by looking at the decision of each individual household using the objective function. And finally, after this, I'm going to show you the results of aggregate results of land reform. So let me start with the model. So it is heterogeneous agent model, and agents are heterogeneous in 5 parameters. The first 2 are related to their level of productivity, first in agricultural sector, second in entrepreneurship. Both of those productivities, they are not constant across time, they're subject to idiosyncratic shocks, but households kind of aware what the probability of each of the shock. Second, households own some land, which is non-negative, and this land could be either private land or communal land. And when I say communal or private, I mean communal land is land with weak land property rights, private land is land with strong property rights. And finally, households can accumulate endogenously their wealth or financial assets. It's infinite horizon and time is discrete. And what model has? First model incorporates endogenous occupational choice. And there are 3 occupations available for each household. They could become farmers, entrepreneurs, or they could become workers that are being hired by entrepreneurs. Second, the model has endogenous evolution of communal land, and I'm going to stop on this a little bit later more to capture this use it or lose it principle. Finally, it's forward-looking saving decision or accumulation of financial wealth, and both land and financial markets are incomplete. So now, before I will show you the actually household problem or optimization function, let me talk about imperfections on 2 markets. Starting with the land market, there is total amount of land which is fixed available in the economy, and share of this land, mu L, is communal, or as I mentioned before, it's land under weak property rights, and 1 minus mu L is private. And each household endows some amount of land which is non-negative, and what is key here, what are the differences between communal land and private land? So communal land, first, it could not be rented out. So households, even if they have it, they're not allowed to rent it out. Second, it's subject to expropriation risk, but only in the case it's not being used in their production. Again, to capture this use it or lose it principle. So the way it's going to work, imagine you a household and you have some amount of communal land. Then in a given period of time, you decide, shall I use all the land? Shall I become farmer or move to other occupation? And if you decide not to use part of your land, this land will be subject to expropriation risk. So in other words, with some positive probability, this land, the village head gonna take from you, and then this village head gonna relocate this land to other who are eligible, with some positive probability pi r. And the way in the baseline model, I assume that pi r is positive only for those households that are already staying in agriculture. And finally, communal land cannot be used as collateral. And on the other side, private land is not subject to any land market imperfections. However, everybody in the economy is subject to financial market frictions. So the way financial sector works in this model, it's very simple. In terms of the financial intermediary, it's competitive. It takes deposit and make loans. And I assume the following financial market frictions. First, there are no state contingent bonds available in the economy, which means that households are not able to insure themselves against those productivity shocks that they experience. Second, I assume that financial wealth is not negative, meaning that households are not able to borrow to smooth out their consumption. However, they're able to borrow within period to finance their capital usage. But the amount of financing that's available for those households is subject to a limit or to the collateral constraint. And what households are able to use as collateral? 2 things. First, they're able to use their financial wealth, and this choice of how much financial wealth to have or accumulate throughout the time is endogenous. And second, they could use their land, but only if this land is private land, if it's under strong property right regime. Therefore, if we combine and do a little or very simple mathematical derivation, we find that the amount of capital that households are able to use is limited by some fraction of their financial wealth, as well as some fraction of their land, given the price of the land. Okay. Now, just to give you a little bit more details on how households making their decision, what I'm going to do here, I'm going to show you household problem conditional on occupational choice. So in the model, each household maximizes their value function among 3 occupations, but within each occupation, there are differences that I'm going to highlight between private landholders and communal landholders. And most of the things that highlighted here in orange is actually represent those differences in terms of the household choices. So first, remember, I told that private land is not subject to any land market imperfections. Meaning that households that have private land, their land not subject to any expropriation risk. Therefore, you see that in the state variable of the private landholders, Li is not doesn't have any t subscript, meaning that the amount of land that they have is fixed across time, or the amount of land that they own is fixed across time. Second, they spend their money on consumption and accumulation of assets, and the income coming from 3 sources. First, it's income from the occupation. Second, it's interest income from their financial wealth. And finally, it's rental income from the land that they are not using in their production. Again, it's highlighted in orange because only those who have private land are allowed to rent out actually unused land. Finally, both entrepreneurs and farmers using capital in their production, and this capital is limited by their amount of financial wealth and the amount of land. Now going to the income from each occupation, the income of entrepreneur is very simple, is the profit of the firm that this entrepreneur runs, and the output of this firm is determined by the household's entrepreneurial productivity, amount of capital, and amount of labor that this entrepreneur uses. The income of worker is very simple. It's the wage that entrepreneurs pay to their workers, and the income of the farmer is the profit of the farms that this farmer operates, and the output is determined by the level of agricultural productivity, amount of capital, and amount of land is being used. Here are 2 important things. First, as you can see, both for entrepreneurs and for farmers, the production functions exhibit decreasing return to scale. So this assumption would be very important when we come to the quantitative exercise in terms of what would be the efficient allocation of resources. And I'm going to get back to it when I show you some empirical results. Secondly, if you look at the production function of the farmer, you observe that the farmer is using only capital and land, and they do not hire any labor. So this assumption is very convenient for the model purposes, but also it reflects what we at this stage observe in the data in Tanzania. So when we look at the farmers that operate in Tanzania, most of them are small farmers, but on top of this, most of the labor that they use is coming from within the household. So 90% of the labor employed in agriculture is actually household labor. So I think like for now, for given current state, this assumption is okay. Question is, when we do land reform, whether this is going to change? I think yes. This is not how it's modeled yet. Okay, now let's move to those who live under communal land. Now thinking first about farmers. So when we think about farmers and their difference compared to the private landholders, those farmers are not allowed to rent out their land, right? But their production function is increasing in land. Therefore, in optimum, those farmers would never use less land than they actually have. They might use more land, but never less. Meaning that if they decide to become farmers, their land never going to be subject to expropriation risk. Therefore, in terms of their production, in terms of their value function, with some positive probability pi r, in the next period, they might receive this endogenous amount of entities that being expropriated from everybody else in the community. And with probability 1 minus pi r, they're going to remain with the same amount of land as before. And here again, here now you don't see this orange that been here before, simply because they're not allowed to rent out their land, and the amount of capital they're using is subject only to the amount of financial wealth, since they couldn't use their land as collateral. Now, when we're thinking about workers and entrepreneurs who own communal land, they're not using any land in the production. Meaning that all lands that they have will be subject to expropriation risk. Therefore, in the next period, with positive probability pi e, all the lands that they have right now going to be taken away from them, and with probability 1 minus pi e, they're going to remain with the same amount of land. And again, the rest of the problem differentiates it from the private landholders similarly. They're not allowed to rent out land, entrepreneurs not allowed to use land as collateral. And now I want to spend like 5 minutes on the data and how I use this data to show that there is misallocation in agriculture in Tanzania, and that this misallocation is linked to these land and financial market imperfections. And the reason why I chose in Tanzania, because first, it's countries that are very dear to my heart. It's the country where I first traveled solo, but this wasn't the reason primary. It's because it has great data and some variation in land property rights, both across household and across time. So first, around 70% of land there is communal land, while the rest is private. And secondly, the government there actually realized the issue of insecurity in land property rights. And what I think actually when I read what happened, I think actually De Soto came to visit the government and suggested you need to privatize all the land so households will be able to use this as collateral. However, the problem is that those reforms are not cheap, and therefore they're primarily financed by foreign governments and NGOs. And the way it worked in Tanzania, particular NGO, foreign government, they decided, oh, those are going to be the districts where we're going to give titles to the households. And then they came, they measured the land, installed the computer and everything, but none of those foreign governments or NGOs were able to finance the entire reform. Therefore, we see some progress, but it's very far away yet from 100%. But for me as a researcher, too bad for Tanzanian people, for me as a researcher, it still gives me a variation both across time and across space that I'm going to leverage in my empirical exercise. So what exactly I'm doing? So I'm starting by estimating agricultural production function. An estimation of agricultural or any other production function, of course, is subject to endogeneity concerns. And in my paper, I'm addressing them by using dynamic panel approach, which I think way more appropriate both for agricultural setting and for low-income country compared to more structural approaches. And what I find is that in Tanzania, agriculture is primarily labor and land intensive, and most of the households do not use any capital. And when I say do not use any capital, I'm not saying they don't use tractors. Most of them do not even use any type of tools to help in agriculture. But importantly, remember when I showed you the models that one of the key assumptions I'm making that production function exhibits decreasing return to scale. And this is indeed what I find. I find that the production function or agricultural production function in Tanzania exhibits decreasing return to scale. Why it's important for my empirical exercise? Because if production function has decreasing return to scale, then when there are no market frictions, what we're supposed to observe in the data is that the amount of land that each farmer uses is supposed to be proportional to his or her productivity. And this is exactly what I'm testing in the data. Do we observe this relationship there? And the answer is yes. We do observe this relationship, and indeed the amount of land that farmers using is proportional to their level of productivity. However, again, if there were no frictions, this relationship should not vary across farmers. So it's supposed to be homogeneous irrespectively of some other characteristics. And this is exactly what I'm testing, whether it's homogeneous or not. And what I find that it's actually very heterogeneous, and this heterogeneity is specific coming from insecurity in land property rights and access to credit. So I find that the relationship higher for households who has or own land under strong property rights and those who have been using some credit for agricultural purposes. This kind of suggests that land misallocation linked to land and financial market imperfections. Of course, this exercise relies on a number of assumptions, and in my robustness findings, I'm trying to address them by estimating, by relaxing the assumption production function, by trying to address selection issues. Importantly, what I'm also doing, I'm kind of exploiting this fact that like most of the land reform or most of the land titling throughout these years happened because NGOs and foreign governments finance, and it's kind of, at least within those villages, supposed to be exogenous. While again, it's like I don't want to do very strong claims. I also like only looking not cross-sectional and time variation, but also only time variation, I find the same result. So total, I'm doing like 20 more exercises, and the findings are consistent. Finally, what I want to point out, and this is important in terms of like my modeling choices, and I will come back to those things a little bit later when I show you the model mechanism. Again, I'm here exploiting only variation across time, so I'm controlling for households' fixed effect. And what I find, that households who obtain title for their land, they're more likely to get the loan, and conditional on getting one, the size of the loan is larger. Second, they're more likely to rent out their land. And finally, in terms of the occupational choices, they're more likely to operate non-agricultural enterprise, and they're less likely to be in agriculture by different measures. And I will get back to those assumptions. But again, here, importantly, this is not an RCT. So I couldn't claim like perfect causality, but I think given what I'm doing and throughout all those exercises, consistent results, I think at least it's convincing that there is something going on. So now, let me come to the quantitative analysis, which in my opinion, the most exciting part of the model or of the paper generally. And I'm gonna start by describing the model mechanism before I'm gonna turn to the results of the land reform. And the reason why I want to proceed this way, because model is quite complicated and has many things going on at the same time. So showing you how decisions of the household depend on whether they are subject to different types of frictions, I think will give you kind of very intuitive understanding of the aggregate results. And just to remind you, what are main channels through which land market imperfections affect economic outcomes? First, it's expropriation risk. This would primarily affect efficiency of labor allocation. So in other words, as you will see in 1 or 2 slides, people would be scared to lose their land, therefore this would prevent them from moving from agriculture to other sectors. Second, inability to rent out land will affect the efficiency of land allocation, because there would be some farmers who would not be able to get enough land, but there also would be some farmers that will use more land than they're supposed to, because they're not able to rent it to other people. And finally, inability to use land as collateral prevents households to get access to credit, and this effect particularly strong for the poorest one who do not have much of financials. Now let's look at like a little bit more formal, or how this would look in the calibrated model. So what I'm going to do here, I'm going to show you a number of slides or graphs, which are going to show you the differences between the household's decision made by those who live under communal land versus private land. And just to keep in mind, all the small plots that I'm showing, they're just slices of the entire distribution to make this kind of presentation more intuitive. And the first one, I'm going to focus on the land misallocation. So this particular plot shows you the ratio of the land usage by communal farmers relative to how much the same farmers would use if they had private land. And I'm starting with those who own large pieces of land. And here on this plot, you have financial wealth or level of assets on the x-axis and the level of agricultural productivity on the y-axis. So importantly from this graph, what you should see is that it's quite dark, meaning that this ratio is higher than 1, suggesting that communal landholders using more land, conditional on becoming farmers, than the private one. So why is they using more land? This comes from the fact that communal landholders are not able to rent out their land. So what's happening here, they have large piece of land, they're not able to rent it to anyone else, production function is increasing in land, so in optimum, they decide to use the entire land, while the private landholders, they rent out pieces of land. So this inability to rent out land basically results in overusage of land by communal landholders. Next, if we look at the medium-sized landholders, on contrary, part of the plot is very light, meaning that communal landholders actually using less land than the private one. So why this happening? This primarily comes from the inability to use land as collateral. So what happens here? So communal farmers, they look and decide how much land and capital they want to use in their production. And then, since they couldn't use land as collateral, they're only able to use their financial wealth. And those who highlighted in light, they're financially constrained. So they're not able to obtain enough capital. Given that they're not able to obtain enough capital, in the optimum, they're not using as much land. And as you can see, this kind of effect vanishes and become equal to 1 for those who are super rich. For those who are super rich, they don't care whether they can use land as collateral or not because they have enough financial wealth. And finally, when we look at the households who do not have any land, the entire plot would be equal to 1, meaning that there are no differences because they're not subject to any land market frictions because they don't have any land. Okay, and so this is a little bit bringing those pictures with the data, or like I call it sanity check. So what I'm doing, I'm simulating the data with my model and run pretty much the same regression as I described before. I'm regressing the amount of land used by each farmer, conditional being farmer, on his or her productivity, and pretty much I'm finding very similar, if not the same, point estimates. And then I also look whether there is heterogeneity between those who live under communal versus private land and compare to my outcome in the data. And it looks very similar. Now let me talk about labor allocation. So when households making their occupational choices, I'm going to start with households who are having very low entrepreneurial productivity, meaning that it's simply the households that do not have any business ideas, so their choice pretty much coming to become either farmers or become workers. And when we look at the private landholders, and again, this is a slice, those private landholders not subject to financial frictions, but what you see here, that their decision is based on their level of relative productivity. So those who are productive in agriculture are going to become farmers. Those who are not, they're going to become workers. However, if we look at the communal landholders, most of them are going to be farmers. So why are they becoming farmers? First is because of expropriation risk. So households knowing that if they become workers, their land might be taken away from them. Therefore, knowing those potential losses in the future, everything else equal, they prefer to stay in agriculture to prevent losing the land. Second, even if there were no expropriation risk, this threshold would be different. Because remember, they're not able to rent out their land, so their outside option is different. So becoming a worker for them is less profitable than for those who living under private land. And again, if I look at the data, I find that households with titled land they're less likely to stay in agriculture, both in terms of the main employment of the head of the household and also in terms of the working hours of the household. Second, if we look again on the occupational choice of household, but now looking at those who have high entrepreneurial productivity or have some amazing business ideas. If we look at those private landholders who are not subject to any financial frictions, all of them decided to go and become entrepreneurs. On the contrary, similar to the previous picture, when we look at those who live under communal land, they're more likely to stay in agriculture. And again, where is this coming? The first one, similarly to the previous one, is because of expropriation risk. They're afraid to lose their land if they're moving outside of agriculture, and therefore they're less likely to become entrepreneurs. And this effect is very pronounced, or like very visibly can seen, if we compare the same type of households, but those who own medium land and those who own large plot of land, and we observe that the effect of staying in agriculture is way larger for the large landowners, because simply losing a larger piece of land in the future is more harmful or creates more loss. Do I observe this in the data? And the answer is yes. So when I look whether your occupational decision depends on the size of your land across both private and communal landholders, I find that it depends on the size of your land, but only for those who have untitled land. So size of the land doesn't determine your occupation for those with private land or those who have title, but it determines your occupational choice once your land is not titled, similar to what I find in the model. The second reason why we observe that more people stay in agriculture compared to become entrepreneurs in communal land property right regime it's again collateral channel. So in the model, I assume that production function of entrepreneurs is way more capital intensive than the production function of agriculture, similarly to the data, and therefore there is in optimum more capital required to become entrepreneurs. So as you can see, this can perfectly be reflected for this kind of step function, because the probability of becoming an entrepreneur for the same characteristic is increasing with financial wealth. Because those with financial wealth are not constrained, so for them it doesn't matter whether they can use their land as collateral or not. Okay. And surprisingly, on time, probably because there were no questions. But now let me talk to you about the effect of land reform. And I hope after I describe the mechanism, it's going to be very intuitive, but it also could be that I'm delusional about this. Okay, so what I'm doing in my main exercise, I'm looking at the effect of two steady states. So I'm starting with a steady state calibrated to the current or situation in Tanzania in 2013, where 20% of land is being private land and 80% of land is being communal. And what I'm doing in my main exercise, I'm basically moving from this mixed economy to the economy where all the land is private land. So we privatize all the land. So what I find as a result of this reform, that it leads to quite substantial increase in agricultural output by 7.2%, or 7.6%. And this effect is driven by two things. First is by ability to rent out communal land. So as a result of this, land utilization or land supply increases, so land utilization goes to 100%, which of course drives up agricultural inputs and as a result agricultural output. However, the main driver of this increase is improvement in agricultural productivity, which comes from the fact that as a result of this reform, land is being reallocated from less productive farmers to more productive farmers. And this reallocation drives around 70–80% of this increase. Even more surprisingly for me was that this land reform also leads to increase in non-agricultural output by even higher magnitude, by 8.2%. And this increase is driven first by better allocation of households across different occupations. Now, with the removal of the frictions, households are able to move to sectors where they're actually more productive, increasing average productivity in non-agriculture as well. But also now they're able to use land as collateral, meaning that inputs in non-agriculture increasing because they have access to more capital, and as a result of ability to use more capital, they also increase demand for labor. Yes, Igor. Steady state to steady state. I'm going to talk about transition dynamics if I...
Given you're not fixing the financial constraints of accumulating more assets.
So interestingly so financial constraint here is fixed. So in this exercise, and in Tanzania it's crazy financial constraint. So it's like collateral to loan value is 250%, which is even high by sub-Saharan Africa. So this I'm fixing, so this doesn't change. But then I'm looking at the effect of financial reform as well and compare with this. Okay, so now a little bit more about other things that coming from general equilibrium. So what's happened as a result of this reform in terms of occupations, we observe that households moving from being farmers to become entrepreneurs and workers. So why this is happening? First, removal of expropriation risk makes people not willing to stay in low productive agriculture anymore, simply for the fear of losing their land, so they're willing to move to other sectors. Secondly, more people can enter entrepreneurship because now they're less financially constrained, so they can start their business. And now when we look at the prices, more entrepreneurs exist now. And second, even existing entrepreneurs are less financially constrained. Therefore, the demand for capital increases, pushing the price of capital up. Since the demand and the amount of capital increases, it also increases the demand for labor, pushing wage up, and as you can see, the amount of workers increasing. Surprising result is that the price or rental rate of the land is declining. And there are two reasons. The first one is, again, ability to rent out land, which, as I mentioned, increased land utilization or land supply. So land supply increased, therefore this pushes the prices down. But second important result, or where this comes from, you see that many people want to move outside of agriculture. And again, this model is a closed economy, so all the markets have to clear. So to prevent all this huge outflow of people from agriculture, the input prices or profitability of agriculture has to increase. And since I'm not changing agricultural production function, the only way for this to happen is for a decline in the prices of inputs, which is including rental rate for the land. And you can see this even more clearly. I'm not going to spend too much time on this, but if we compare partial equilibrium, where all the prices are fixed, the outflow from agriculture way larger. So part of this decrease is to prevent people from going from the agriculture. Okay. And this is my last slide, and I believe I have 3 minutes. So I'm not sure, but let me just briefly summarize other things that I'm doing in the paper. So the model is very rich, so it allows me to do many things. And kind of this is where the main contribution to the literature comes from. And first, as you've seen, compared to other models on land market imperfections, it has 3 different land market frictions modeled separately compared to we have one land market wedge, which allows me not only to study land market reform as a whole, but also to decompose it to different channels. So I could separately look, what would be general equilibrium effect if we just allow land to be used as collateral, so on. And I think it's particularly important in low-income country setting where even if reform is being decided, implemented by the government, it might not go super well. So when I look at different channels, I find that really what drives the increase in agricultural output is this ability to rent out land, because it increases land utilization, but also this is what allows land reallocation across farmers. Increase in non-agricultural output is primarily driven by collateral channel and no expropriation risk, or kind of now we remove this expropriation risk. And here, just to give you a little bit magnitudes, without going to the details, it's mostly coming from collateral channel, because I'm able to measure this expropriation risk in the data, and it's not super high in Tanzania, at least the currency rate is around 9%. But both of those channels, they're really driving non-agricultural output. Coming back to Igor's point, in the mainland exercise, I'm keeping financial sector imperfect. But then having those 2 imperfections allows me to compare the effect of 2 different reforms. Again, when we think about low-income country setting, most of those countries, in case Tanzania, they're not even able to implement land reform, but generally most of those countries not able to implement first best and improve all the markets. So this model kind of allows you to compare the results of different reforms or how they would affect different sectors differently. So what I find as a result of financial reform, when I kind of relax financial constraints to the level of advanced economy, I find that its effect on different sectors is very actually similar to the collateral channel of land reform. So it's kind of depressing agriculture, really improving non-agriculture. But what is different is that financial reform has very different distributional consequences. So when we look who is affected by land reform and financial reform, we observe that land reform on every angle is great because it also decreases inequality measured by consumption. And why it decreases inequality? Because when we think about those who are the poorest and who benefit the most, is those households who do not have any financial wealth and not able even to accumulate it, but they have some land, and then when the land being privatized, their gains are tremendous. So the consumption inequality actually with the land reform is decreasing because the poorest benefit the most. And probably if I measure this in terms of the utility equivalence, it would be even more pronounced. On contrary, financial reform, it really benefits those who kind of already not doing that bad, is those who already have access to finance by simply expanding how much they could get from this finance. And therefore, and if we care both about inequality and the output, of course, land reform looks way more attractive. And finally, I'm computing post-reform transition dynamics just to see whether moving from one steady state to another one doesn't take 2,000 years, and it looks reasonable. It seems that the most changes happening within the first 7 years, but like fully like in the epsilon, we're moving in around 20 years. Yes, and I'm happy to finish here because this part is infinite amount of time can be talked through. Thank you very much.
Thank you. Let's go to questions. Okay, one question from me. Do you have a possibility to observe in your data whether you have this general equilibrium effect on the prices of land?
So prices of land is the trickiest part, very unfortunately. And this is partially, I didn't go into detail because of the sake of time, how I model land market precisely in my paper. But the problem, first land transactions are very rare, still very rare, because like even now the percentage of private land is like 20% there. But beyond this, in the surveys that I have, the only questions they ask, what do you think the price of your land? So, of course, I looked whether it's differentiated by the title or not, and I find that perceived land price is higher. And here are my two explanations. One is like the one that I could justify completely by my model result is that like, oh, this is just a perception, it's not actual price. But I want to be honest, and there are some limitations of my model. And this is where I see where there is one effect of land price that I'm not capturing. Again, it is because I didn't talk too much about how I organize land markets, but basically once we move for land reform, because the way the land market organizes, households not internalize the fact that they could use land as collateral in the price of the land. So they internalize it from other perspective, but not in the price of the land. Therefore, I'm not capturing this increase. But in reality, they probably would. Unfortunately, I mean, you have to make some compromises in those models, and this was the one I made, but I recognize it.
So. Okay.
In your data, do you see some households owning both private land and?
Yes, again, it's like this is something that I assume here that households either private or not. But this is I'm not concerned based on the data, but I do observe that some households own both. So they might inherit some piece of land, and then they'll receive something from communal chief. So it doesn't bother me that much because the way I'm doing in the model. Yeah, so it's like when I do in the model, I'm matching. Yeah, so I'm matching exactly the distribution of land, of private and non-private across household. So what I'm doing, I'm actually, the way I'm calibrating model, when I say 80% of land communal, it doesn't mean that 80% of household own communal land. It means that I'm exactly matching this distribution. So it's 80% of land communal, but it's not necessarily reflects that it's owned by 80% of household. So this is why I don't see this as a problem for the model. For the empirical part, all the measures of security of land property rights, it's not dummy variable 1 or 0, it's exactly the share of private land owned by each household. So I'm taking this into account as well. But yes, I observe this in the data.
And does it change by level of financial assets in the household?
Whether the title and so what I don't observe financial assets. What I know about them, I know the credit, so I know whether they took credit or not, and I observe that they're more likely to take credit once they own title land. And I observe in terms of the assets mostly capital for agriculture or some durables. And I observe that title land holders more likely to use capital in their production. Yes.
Okay, so
thank you. Thank you so much.
Thank you.
Thank you. Thanks everybody for coming. This I know I certainly enjoyed this thoroughly, and it's I'm gonna make a macro comment. This is great to see overlap in generations. The fact that a couple of our own, we're always happy to take credit. Our own students are back to present at the conference. Is fantastic, and let's keep it going. And hopefully, sometime soon, in a independent, free, and growing Belarus.
Thank you. Yeah. Well, coincidentally, tonight is the longest night in the year, so it's very tempting to say that, you know, going forward, it's only going to get better. So, of course, every day our thoughts and donations are with Ukraine, and we hope that next year is, well, at some point it should get better for all of us, right? So, I mean, we are at BEROC very happy that you are here with us together for the conference, which, again, we haven't been able for the last 2 years to have, and finally we are able to have it here in Vilnius. We are very grateful for you to have you here. We are very grateful to our partners with the EHU, and we look forward to the new BA program we hope to launch already next year, again with EHU in economics, and we hope that, well, to involve many of you in the process, and hope to see you again in the years to come, and maybe not in Vilnius, but sometime in Minsk finally. Thanks.
And thank you very much for people who actually organized all of this. Sveta, thank you.
Yeah, and most important thing, now we have the reception, which is in the hall right out of the door from this audience hall. What do you call this? Conference room. Thank you. Thanks.